Hit it. It's April 10th, 2020, episode 75. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we have a special episode. First, we start with two interviews from SPAC experts, Jamie Wise from Periscope Capital and Benjamin Kwasnick from SPACresearch.com. During the corona crisis, SPACs declined to levels that offered attractive risk-free returns. We felt listeners would be well served learning about the opportunities in this space. Then, for our main interview, we are pleased to welcome FinTwit star, The Longview, a.k.a. Hayek and Keynes.
And then we finish with talking charts and the top 3 things to watch next week. So let's get to it.
Okay, we now have a special feature where we're going to have one of my good friends and one of my buddies that actually was originally a client way back when join us to talk about SPACs. So welcome to the show, Jamie Wise from Periscope Capital.
Thank you so much, Kevin. Good to be here.
So we have to kind of chat about how we met. And it was a long time ago, in 1998, I guess it was, right? And were you in New York at the time?
I was in New York at the time. I had just begun my career, fresh out of business school, and off to Citibank I went to start a job on their equity derivatives trading desk, which at the time was an OTC desk that serviced clients globally, but I was positioned, probably because I was from Canada, on the Canadian desk, where we traded single stock options and the Delta One portfolio. So swaps, index linked notes, things like that.
Right. So although Citibank is in some ways a competitor to RBC, on another way, you are actually our client because when you were wanting to execute large blocks of indexes or stocks, you would actually phone us up and chat with us, right?
Right. We were at the time an OTC desk primarily. So when we, being Citibank, needed to lay off some of the risk that we were taking on, we would look to you in the dealer community to either try and lay that off in the exchange traded market, or there was an interdealer market that we could try and trade against each other. But for the most part, we all had the same exposures on, so there wasn't much to do there.
Right. So now I kind of laughed. We made a chart up here. And it's the Toronto 35 index, which was the predecessor to the Toronto 60 index. And you started what, in the summer of 98?
I started in June of 1998. That is correct.
Right. And the index was 410. And within 2.5 months, the index had gone from 410 to 280.
Well, it's an even better story than that because I wasn't supposed to start till the end of the summer, right? Like most people, I was going to graduate. I was writing CFA level 1, I think, back then. And then off to Europe, I was planning on going. And then, you start at the end of the summer. And the guy who hired me, so this is at the time, remember, when I joined Citibank, it was pre-merger with Citigroup, with Solomon. But in between the time that I signed my contract and June, they had announced that big merger. So right. I was the thoughtful student. I call up, the guy who hires me, and another person answers the phone and says, "Listen, kid, that guy's already gone. We're not going to renege on a job offer to a kid coming out of school. But if I were you, I'd get here as quick as you could." So I essentially wrote level 1 of the CFA exam in June. The next week, got on a plane, moved down to New York, and top ticked the market, as you are thoughtfully reminding me of right now.
Right. And then the best part is they put you in charge of the Canada book.
That's right.
So armed with your CFA level 1 and your economics degree, or did you have an HBA?
My economics degree, and I had spent the summer before working on the options floor of the Toronto Stock Exchange. So for a summer before it moved to Montreal, I'm really going back now, it was an open outcry pit. And I was the summer student on that floor relaying option orders to the market makers with the old hand signals, straight out of Trading Places.
Right.
But that was the extent of my options experience.
So needless to say, you probably didn't understand a lot about option theory on that first day. How long did it take you to figure out?
Well, let's just follow along the chart here. You know what? I have to say, learning from the guys on the floor. Now, remember, the guys on the floor weren't, derivative heads, bean counter guys like we're so used to data scientists in today's community. These guys were by and large high school students that had no formal education that sort of found their way onto the market making desk, but they understood risk and they understood it like many Canadian traders, which took me a while in my career to figure out, understand risk from a supply and demand perspective, right? That's how they thought about risk. They didn't think about Greeks and vols and what was moving in what way. They just knew when there were more sellers than buyers, and it didn't matter that meant that implied volatility levels were changing. They just learned to manage risk in that perspective. So that's sort of how I learned it. When I went to Citibank, all of a sudden I had this big portfolio of options that I was responsible for. A lot of them were index-linked products that we had sold as sort of insurance to bank-issued structured products or principal-protected notes. And there was one, I remember, very large derivative exposure on the book that was sold to help a pension plan hedge themselves. And it was a caller transaction. So it was like a 460 call versus a low 300 level strike. And as you can see on that chart, we went through that strike a couple of times. And I remember very clearly sitting on the desk, calling you up and, trying to trade baskets as the market's falling. I need to hedge my gamma, and I'm selling basket after basket or future after future. And then as it's getting whipsawed around, trying to cover those exposures back, with the head of the desk leaning over every once in a while, looking at me saying, "Everything okay over there?" Yep. I'm going to pick up the phone and call you. Sell another 20 baskets, Kevin.
Well, do you know what I love about that, Jamie? I remember you hitting me. You'd phone me up and you say, "Where do you bid on 20 baskets?" I'd bid kind of a couple bucks below the bid. You'd hit me. I'd go to print it. I'd sell 3 baskets, and then I'd be left with the 17. But the trouble is that my gamma would make me long another 10 or 20 as well. So all of a sudden I had to sell mine and yours. And then you would be phoning me up saying you want another bid on 30 this time.
It's relentless, right? The size was, and I wasn't the only one in the market because, back then the way the street worked, there were, a few OTC dealers, and that pension and other types of clients would basically stuff everyone with the same positions, right? So
Right.
The Canadian OTC street all had the same exposure. And that's when you really learn about what liquidity means, because you can't get off your positions, right? It's not like we were trading S&P 500, even though vols are exploding, there's still lots of liquidity in that market, and you can make a decision to cover or reverse your position. I'll never forget one night going home from work, sort of distraught by that realization. And I was walking down the street with who I thought was the smartest guy on our desk. I always referred to him as Spock because he was like a Vulcan. He was just so logical in his thought process. And he looks at me and he says, "Well, what are you complaining about? If you don't like your position and you're sort of losing under every scenario, you should just go the other way and then you'll win under every scenario. You can do that." And I thought, well, first, damn you for being so logical. And then second was, I can't do that. There's absolutely no way I can get off this exposure other than trying to manage the gamma by stuffing Kevin with baskets.
That's right. It was a lot of fun, though. It was great to have you. It was great to get to know you. Now, since then, you've gone on. You went to work. You came back to Canada. You abandoned America and came back to your hometown, and you worked on the sell side at Bank of Montreal. But since then, you've gone on to make your own hedge fund. That is one of the strategies that you employ there is about SPACs. Correct. So why don't you tell us about SPACs, what they are, and give us your kind of spiel on them?
I'm happy to. So I started Periscope about 10 years ago. SPACs was not a strategy actually for our shop when we first started, but has been for a little over 5 years now. What got us interested in SPACs was really the risk return payoff profile of the strategy. But before we get into all of that, for those listening that aren't familiar with SPACs, it's probably helpful to have a very quick primer. What is a SPAC, right? And SPACs are nothing new, by the way. SPACs have been around in one form or another for 20 plus years. A SPAC is an acronym that stands for a Special Purpose Acquisition Corp. And essentially, it's like a blind pool of capital where a sponsor team is looking to raise money to make an acquisition to acquire either a private company or a group of assets and transition them into public life in like a reverse takeover, right? So instead of a traditional IPO, this private company can become public by being acquired by a SPAC, which is itself a public entity. So when a SPAC sponsor team comes with an IPO, they raise typically a couple $100 million. And that comes in the form of a unit. And it's almost always priced at $10 a share. So the pricing on day one really is a function of what is that unit comprised of, which is a share of the SPAC company, plus some amount of warrants and or rights. It could be a quarter of a warrant, half a warrant, a full warrant and a right. And those variables are largely a function of the pedigree of the sponsor team and the market's view as to the potential for success of that sponsor team to identify an attractive acquisition to purchase and then bring public through the SPAC vehicle. Does that make sense?
Yep, you got us.
So that's essentially what a SPAC is. So why do SPACs exist? That's the first question, right? SPACs are not the perfect way for every company to go public, but more and more they've become a really accepted alternative for certain types of companies. And they may be companies that need a little bit more pedigree at the management level, at the C-suite level, right? They need some market savvy. So typically sponsors of SPACs might be former chief executives of publicly traded companies, or senior executives from private equity firms, people that are used to facing long-term fundamental shareholders and communicating a story to them. It may be possible that a target company may be looking to just sort of sell its assets, and instead of selling the business, it's a way of monetizing it. But it typically fits small to medium-sized businesses. So you're thinking about enterprise values of 1 to 4 billion. Right? So if you're Uber and you're a very large institutional-like private company, you don't need a SPAC vehicle to access an IPO market. But for these smaller mid-market type companies, it's a nice way for them to gain access to institutional-like investors and have a more controlled vehicle to negotiate with those investors on what the capital structure of that company should look like going forward, so that there's some alignment between the permanent shareholders ultimately of that company and the structure of that company. And you can negotiate that in a more nuanced way in a SPAC vehicle than you could by way of a traditional IPO, where you sort of here's the document, here's our pricing, take it or leave it.
Right now, so one of the things I'd like to make clear is that the SPAC actually trades before the assets or the takeover is announced. It generally has a sponsor, of which that is the management or whatever the team is, that wants to go out and find that. Now, maybe it'd be good to go through an example of just kind of what a typical, maybe could you pick an example of a specific SPAC that's already gone through and turned into a regular company?
Sure, there's lots. There's one that's going on right now that's actually quite interesting, which is Diamond Eagle Acquisition Corp. They came as a SPAC. Let's pull it up. It's about a year or so ago, I would say, maybe a year and a half. You can pull up the chart. They came to market.
What's the symbol, by the way?
The symbol there is DEAC.
Okay,
so that's Diamond Eagle Acquisition Corp. And they came to market with, an idea that they're going to target something in the consumer space, and off they went, right? So they typically have, a SPAC will typically have about 2 years to find an acquisition. And if they don't find an acquisition, then they simply wind up the SPAC and return the day one capital to the investors. And this is important. We should spend a little bit of time talking about this. When a sponsor team decides they want to launch a SPAC, they start sort of that's the beginning of this SPAC's journey or life cycle. And so they'll typically go and hire a banking syndicate, and then they'll go around on a first roadshow to investors like Periscope, and they'll talk about why it is that they want to buy, why it is they want to do a SPAC, why they have some sort of experience in this sector, in this industry, and why they think they'll be successful. And then there's sort of the first round of price negotiation, which is how many warrants and rights or different attachments would be necessary to entice us as a SPAC investor on day one to give them this pool of capital to go out on their search and allow for them the time to find an acquisition. Once that is negotiated, the SPAC will actually complete its IPO. And like you said, it'll start trading typically on New York Stock Exchange or NASDAQ, and it'll trade for the first 3 months as that unit. So it will trade as the shares and the warrants stapled together that was issued at $10, and it will trade right around $10 because nothing has really happened yet. They haven't made any types of acquisitions. And then they go out onto their seeking phase, which is they're going to look for this acquisition over the next 2 years. What's very critical to the structure of a SPAC is that 100% of the IPO proceeds, so those $10 per unit, all get placed into an escrow account where the SPAC sponsor team has no access to it. That is fully on reserve for SPAC shareholders to be able to redeem either at maturity of the SPAC's life, which is typically 2 years, or if they don't want to participate in the acquisition that the sponsor team has offered them at some point during that 2-year period. So that 200 million on average would all go into this trust account, and that gives the strategy or the structure real principal protection characteristics. What
Right,
happens
Jamie?
after?
Can I interrupt
Go for it. Yeah,
quickly
yeah.
there? Not only that, I just want to stress in 2008, I believe that some of the kind of credit where they bought some corporate notes or notes that were not completely government backed, and now there's basically the restriction that they have to put in pure government securities into that escrow account. Is that correct?
Yeah, so I mentioned SPACs have been around for 20 years, but the structure has evolved over time. So if we look, the 10-year ago SPAC structure, sponsor teams or the custodians over the trust account had more latitude into the types of things they could invest in. They couldn't invest in high yield bonds, for example. They couldn't invest in equities, but they could invest in either money market securities or government treasury bills. And in 2008, as you were alluding to, there was certainly stress in the money market where some money market instruments actually broke the buck, right? And so there was this fear at the time that there were some pools of capital in SPACs, right? In these trust accounts that really the principal could be at risk to the extent they were invested in money market funds, and they might break that buck and not return par. And so one structural change over SPACs over the last 10 years is the rules or the box is even tighter around what the proceeds of the IPO can be invested in, which is U.S. government treasury bills, 6 months maturity or less, full stop. So that sort of helps.
So it's rock solid. So the credit portion is rock solid. You're getting your $10 back no matter what.
There's no credit risk at all in this strategy, and there's no duration risk really to the strategy at the same time, because it's short-term treasuries that will just be rolled by the custodian every few months as they mature. So there's no even timing mismatch. It's not like they're going to buy a 2-year treasury and then they announce a deal a year and rates have changed and you could lose on the treasury. They purposefully manage it in short-term treasuries so that the principal is always protected and it can accrue whatever the treasury yield is at the time.
Okay, great.
The second structural change, we can talk about this too, which is very important, is the voting options. So when a sponsor team goes out and has this window to look for an acquisition, it finds a target company somewhere along the way. When it finds that company, it then communicates that to the community. And in the past, as a SPAC shareholder, you really had two choices to make. You could either support the acquisition and continue on as a shareholder in the new company, taking on all the equity market risks that a regular operating company would have, and betas and industry exposures and the like. Or you could vote against the transaction and ask for your money back. Okay. So as a SPAC shareholder, the bar was pretty high on the quality of the acquisition that the sponsor team needed to bring to market for you to support it and maybe take that equity risk, even if you didn't plan on being a long-term shareholder. Today, or in the last 5 years, the structure has evolved such that there's a third voting option that SPAC shareholders have when presented with an acquisition, and that is they can choose to support the acquisition, but still ask for their money back from the trust account. Okay? And you might think to yourself, well, how can that be helpful? If everyone's supportive of it, but yet still wants their money back, where will they get this money now to fund the acquisition? Because typically, once the acquisition is approved, they'll take the money from the trust account and use that to purchase the assets or the company, whatever they're trying to buy. But in reality, what happens is, even if us as an investor ask for our money back, what we're doing is giving the sponsor team a new window of time to replace our capital in order to close their deal. And they can do that in a number of ways. They can access traditional, long-term fundamental shareholders. They could do a PIPE transaction. They could get some sort of debt financing potentially. There's all these ways that bankers and sponsors have to sort of massage the capital structure to be able to backstop and close the deal. And what that has done is it's taken success rates. When we talk about a success rate in SPAC terms, it means a sponsor team has identified an acquisition and closed on that acquisition such that it now lives as a public company. It took them from probably 60 to 65% a decade ago to, over the last 5 years, over 90%. And the ability to have more certainty about potentially closing an acquisition has changed the landscape of the participants within the SPAC ecosystem. So now it's attracted much higher quality sponsor teams and even institutional players acting as sponsor teams. So think of private equity, for example, like TPG. They're actively sponsoring SPACs because there's less risk for them. They know that if they can get supportive shareholders to approve the transaction, whether or not they want to remain shareholders or not, they have all the tools and relationships and experience to know how to go out and find replacement capital if it's needed to close an acquisition. And so the entire market has really grown as a result of not so much the change from the money market to the treasury bill requirement of how trust accounts are invested, but really this third voting option. That really changed the game for SPACs. So much so that, last year we had $14 billion of issuance, 10 billion the year before and 10 billion the year before that, where it's representing, 20 to 25% of the overall US IPO market. So a meaningful percentage of the US IPO market comes through this SPAC structure from quality management teams who understand how to execute on the SPAC lifecycle, going from day one SPAC IPO to identifying an acquisition, closing it, and then ushering it into its life as a public company.
Right. So that was a great explanation, Jamie. I interrupted you and you were telling us about Diamond Eagle. Why don't you kind of continue on and walk us through how it worked for that particular stock?
So yeah, Diamond Eagle is a great example to use of why I like to refer to SPACs as reverse risk arbitrage. And the reason is on traditional risk arbitrage, which you're very familiar with, you're trying to get, let's say, an 8 to 10% return by buying this, deal at some discount to its projected closing price, but you've got all the left tail risk that keeps you up at night. If the deal breaks, there's a big, spread widening event that's going to happen, and there's nothing you can do about it, right? Where there's very little upside in risk arbitrage, unless there's, a white knight kind of scenario where someone comes second bidder, those types of things. But for the most part, you're playing for the last, dime of spread that's on the table. In SPACs, it's the complete opposite. So in SPACs, remember what happens here is once the unit separates, now you have different components trading on the exchange. So the SPAC share will trade, the warrant will trade, and maybe the rights trade. And that $10 unit, 3 months into its life, will now trade as maybe a $9.70 share, a 30-cent warrant, and those things. And the warrants are very interesting too, because the warrants allow you to buy a share of the forward company, of the SPAC, struck at $11.50, so very close to the money, for 5 years, but only if they successfully close a deal. And so, coming from an options background, and you have this experience as well, this was something that was very interesting to us because it's sort of like a binary knock-in option, right? Where if they don't find an acquisition, it's totally worthless and worth zero. If they do, even if the stock itself isn't successful, that 5-year option can have a lot of value, right? So when you put your option head on, you start to recognize that those options are probably mispriced in terms of the potential value, because a 5-year almost at the money option has a lot of value. Regardless of the industry it's in. You can get even more granular. A biotech volatility is going to be higher than a consumer products company. And so think about different options different ways. Nevertheless, so those things trade. Diamond Eagle, let's go back to Diamond Eagle. Diamond Eagle trucks along for a couple of years, and all of a sudden it identifies an opportunity to acquire DraftKings, right? So DraftKings, if people are familiar, very large online gaming platform. And Diamond Eagle comes in with their relationship and actually is proposing to acquire not only DraftKings, but SB Technologies, which is a European version of DraftKings. Also, they provide a lot of plumbing to websites that you might be familiar with, and create this online trading behemoth. The market reacts very favorably to that news. And you can see, if you look on the chart here, after deal announcement, there's a little jump. But then in the months that followed, the stock really ran up, right? It got all the way up to $19 a share. Today, it's trading at $14. Keep in mind, even though they've made this announcement, the SPAC, they haven't closed this announcement yet, right? So they made this announcement about a year or so into their life. So this announcement, this stock, Diamond Eagle, that we're looking at, we're not looking at DraftKings yet. We're looking at how the fundamental community expects DraftKings to trade in the future once the deal closes. As a SPAC shareholder, if you own DEAC today, you still own the $10 put plus accrued interest, whatever's in the trust account. So you still have that downside protection. But in the meantime, you have been able to exit your position to the extent that you're an investor like Periscope and you don't want to be in this trade for the long term. You're not in it to become a DraftKings shareholder. You're in it to earn a very, targeted rate of return and keep sort of rolling over that exposure, right? Where we think of ourselves as, chasing the 3.5 sharp kind of trade here, right? But you have the upside optionality of being able to sell your position above the trust level. And when that happens, it's just adding incremental return to the strategy. So the typical strategy return, remember what I mentioned earlier, that SPAC unit, this DEAC, it would have split into its pieces. So I could have owned the share at $9.70 and then had the right to redeem that share at $10.15, call it in the future, because it would have accrued that interest. Plus, I would have gotten that warrant for free, which at some point in the SPAC's life cycle, you can monetize to effectively lower your cost base on the shares. And you can put a little leverage on that. And you have a nice 8 to 10% returning strategy where the risk is really just a portfolio of treasury bills because you always have that put. You always have the ability to redeem. What DraftKings is a nice example of is where you get the upside optionality of the fundamental community really responding well to the proposed acquisition that the sponsor team has brought to market. And even though the deal hasn't closed yet, they're able to buy those shares. Naturally, those fundamental people are going to vote in favor of the deal and continue to be shareholders. And we can sort of slowly unwind positions at prices much higher than trust, adding incremental return to a strategy.
So, Jamie, this is Patrick here. Just are you in a situation where you're selling the underlying but keeping the warrants as an upside bonus type of thing, or vice versa? Do you separate them, or is it that they're attached until the SPAC converts?
No, they separate functionally after 3 months. So you'll see them after the SPAC completes its IPO. 3 months later, the warrants and the shares, or the units, will separate into warrants and shares and trade individually. What your job as a SPAC manager or investor is, and our job, and what we give a lot of thought to, is thinking about those warrants and the right time to sell those warrants, right? And a lot of that will be based on a fundamental view that we have of the sponsor team, their ability to bring a good deal to market, when that may happen, and how the market may react to that deal. And obviously, the higher you can sell the warrant, the lower your cost base is effectively on the share, and better your return on the strategy. But there's no rules. There are instances where we're very quick to sell the warrant as soon as they separate, and there are instances where we might hold on to that warrant. We won't hold on to that warrant for 5 years after the deal closes, but we might hold on to it right until deal closing date. Right? We'll never hold our particular approach to SPACs is we don't hold equity in post de-SPACed operating company. We are always out of the trade at or before our ability to access the redemption feature of the SPAC. So we don't want to take regular market risk. And for the warrants, we'll maybe hold on to them for a week or two after, but not for months or years.
Jamie, when you told me, I remember a year ago when we were talking about this, and you talked about it being reverse risk arbitrage. That was like when a light bulb went off in my mind. I was like, wow, that's just such a great way of putting it. I was wondering why you think that SPACs often have a bad name, and whether you think that this sort of financing is going to, it's increased in popularity. Will that trend continue? Do you foresee this getting even larger?
I think so. I think SPACs are sort of viewed, or historically were viewed, the way convertible bonds were viewed in Canada, right? If you think about convertible bonds in Canada, they were always viewed as this desperation financing measure, right? You have to be a really poorly run company to be desperate enough to issue a convertible bond. Where in the US, they have a totally different recognition amongst investors. It's a totally logical part of a company's balance sheet and capital structure, and investment grade issuers issue convertible bonds all the time. SPACs are sort of treated the same way as Canadian convertible bonds. 10 years ago, the overall level of the pedigree of the sponsor team, it was a bit more of an opaque market. Typically, the banking groups that got involved were your sort of C-level investment banks that most people hadn't heard of, like a JT Marlin. And that gave them that, poor reputation, right? But I think what we've seen now with the evolution of the structure and the acceptance of that structure, not only by the biggest investment banks, but the biggest private equity players in the world, they recognize that the SPAC structure can be a real value add to a company that needs a little help to go public. And they can manage that process and have a really successful outcome with it. So our opinion at Periscope is that's a structural change in both the market's acceptance of the SPAC structure and leads to sustainability of issuance of that structure to serve as an alternative to a traditional IPO for years to come. One other thing that I note that's sort of interesting to look at, the reverse of risk arbitrage, is if you pull back the chart of Diamond Eagle, of DEAC, you'll see that the run-up doesn't really happen on deal announcement. So you can see right there in the middle of December, at the end of 2019, they announced this acquisition that they're trying to buy DraftKings. And the stock goes from 10 to 10.50 and just sort of sits around there for a bit, right? Completely different than a real risk arbitrage strategy. So what happens if in a real risk arb, traditional risk arb, someone's being bought for $100 a share in cash, it was trading at $60 the day before, it's trading at $98 the next day, or whatever the risk arb spread should be. Here, you have to understand the life cycle and the ecosystem. What happens after Diamond Eagle makes the announcement that they're buying DraftKings is they actually will go on what looks like more of a traditional IPO roadshow. So instead of coming to Periscope, they're going to go to Fidelity and to Wellington and to the fundamental community, and they'll meet with them individually and talk about the acquisition they're making. Why are they doing it? How is it going to be financed? What are the pro formas, right? There's even flexibility around that. So to understand, you have to understand and appreciate that process in a SPAC's life cycle, knowing that when is the Fidelity manager going to be able to make the decision that he likes this acquisition and then instruct his trader to go out and buy 1 million shares of the thing with, if he thinks it's worth 20, he's happy to pay 13. So you have to be, even though we're not in it as fundamental shareholders, it's very important to have a fundamental lens and understand how the fundamental community thinks so that you can give yourself the best opportunity of when might be the right time to exit your position. Totally different than risk arbitrage, where the market makes an immediate assessment of the deal, and the next minute it's pricing at that assessment. Here, there's a life cycle and a process that has to play out for that acquisition to be communicated to the go-forward permanent shareholder base.
Well, that's a great note to leave it on, Jamie. Thank you very much for your time. For people who want to learn more about Periscope, where can they find you guys?
You can find us on our website, periscopecap.com. That's probably the easiest place to start.
Great. Well, thanks again.
Thanks, Jamie.
Thank you, guys.
We now welcome to the show Benjamin Kwasnick, founder and author of SPACresearch.com. Thanks for joining us today, Ben. It's great to have you on.
It's great to be here. Thanks for having me, guys.
So I have to give you the whole story about how I found you, Ben. It's kind of funny because during this last market crisis, there was someone brought to my attention that the SPACs were trading really, really kind of fat, meaning that there was a great yield in them. And I started to do a little research on it, and I went through and tried to figure out, how do I find out about SPACs? And I went and looked and went through all the different websites, all the different research I could find, and it ended up being that everybody told me that I had to go see this guy at SPACresearch.com. From our buddies at Periscope to even Cuppy told me that you are the axe on the name. And I'm really happy you're here because it's a great website that you offer, and it's great that you can bring to us all the knowledge that you share with us about SPACs.
That's great to hear. Thank you so much. And yeah, we do a lot of work on the yield that individual SPAC common equities are producing. We have a detailed trust account model that tries to estimate how much cash is in a given trust account at a given time. So we have a lot of different ways to look at the universe of outstanding SPAC equities.
Right. So let's talk about that, because during the 2020 COVID crisis, many of these SPACs actually went down to levels that really theoretically made no sense, right? They were offering yields that seemed almost too good to be true.
Well, I think what you have to look at is a SPAC common equity is a share that's linked to cash in a secure trust account. But it might be a while before the cash can actually come out of that trust account. And in the middle of the sell-off in March, what we saw was participants across the entire ecosystem seeking liquidity wherever they could find it. And so especially a lot of the maybe fundamental holders, if they had SPACs in their book, if the rest of their book was down 30 or 40% and they were looking at a SPAC share that was down, 3 or 5% and they needed cash to meet redemptions or to put it into another equity idea that that was more in line with their mandate, they were hitting the bid because they needed liquidity now.
Right. And so some of these traded at levels that, do you have any examples of the yields that they were trading at? Like what was some of the yields that you could get on different SPACs during that sell-off?
Yeah, so we got a chart. If you go to slide 2, what you can see is the estimated yield curve for the class of SPAC common equities right at March 20th, right around the lows of the entire market. And you can see that the median SPAC was trading 6 or 7% yield with some as high as 10 or 15%. And basically what this means is you're getting paid a 10 or 15% annualized yield just to hold to liquidation. And this is really, in most cases, a yield to worst because there's a lot of upside from here if the sponsor ends up finding a deal either sooner, that is before the liquidation deadline, or if they find a great deal that the market ends up liking enough to buy above cash and trust. There's a lot of upside from there too.
Right. So now you mentioned that some fundamental some fundamental investors that might have been using SPAC as a place to hide were actually the ones selling. Is that something you commonly see? Like, is it a strategy that people that are worried about the market might go and choose to hide in SPACs? And why would that be the case?
Well, I should say I don't exactly know that it was fundamental investors selling. We won't know until the 13Fs come out for the end of Q1 exactly how everyone's portfolio rebalanced. But I think the thing to think about is that most of the capital in the space is running what you'd call a SPAC ARB strategy. Basically, a fairly straightforward kind of quantitative approach where you buy the units for $10 at the IPO, and then you hold on, in most cases, until a business combination is announced and closes, or if the SPAC can't find a deal and liquidates. And then you get a warrant, usually as a part of your IPO unit, and they figure out how they want to handle those. But it's been a pretty successful strategy over the last 5 years. It's done a lot better than treasuries, for example, and most of these guys tend to view it as a fixed income substitute. And so, it's hard to say exactly what fraction of the entire SPAC book is running SPAC ARB, but over the course of the last 6 months, we had a lot of great SPAC deals trading extremely well in the market, even before their deal closed. We've had a lot of high quality sponsors come into the market, and so there was a lot of optimism during the days of Q4 and early Q1 over the course of the tail end of this bull market. And so we saw a lot of participants come in many cases, buying these things above cash and trust. So in the middle of a liquidity crisis, it's very believable that you'd see those marginal additions to the space be the first to hit the bid on the way out. And the returns have been a lot better than treasuries, in many cases 6, 7, 8% annualized, as compared to treasury rates of 1.5% to 2.5% over the last few years. But the thing that you sacrifice owning SPAC common equity is liquidity. Obviously, it's not remotely as liquid a market as the U.S. Treasury market. And so if you need to realize liquidity on an investment right now, you're forced to hit the bid in many cases. In the middle of a broader market sell-off, there aren't a lot of bids across the board. And so that's really what we saw as we came down to these wide yields in the middle of March.
Right. So you go through and you do the work in terms of tracking all these different SPACs and tracking the money that's in them. How many are you currently, what's in your universe right now?
There's about 100 U.S. listed SPACs right now that are in some stage of pursuing a deal. That's anywhere from having filed an S1 through the point where they announce a deal and actually present an operating company that they'd like to acquire. And that is before they hold a shareholder meeting to approve the transaction.
And so how do you track the how much money is in the trust? Is that just from press releases, or is there some sort of automated way to do it?
So we've got a bunch of tools, but the primary way is that every quarter you'll see a SPAC report on its 10K or 10Q, the most updated trust account balance. And then we have a detailed trust account model that takes that most recent report, has a look back on 1 and 6 month treasury rates because they're required to invest in 180-day or less treasury securities, walks that forward, takes out for franchise and income taxes, if any, if they're domiciled in the US. And then also some SPACs allow for working capital withdrawals for the sponsor for operations. And then other times a SPAC will try and extend its deadline if it hasn't found a deal by its original liquidation deadline, in which case the sponsor might contribute to the trust account per share to convince shareholders not to redeem at that extension.
Right, that's one thing that we didn't get into with Jamie very much, but maybe you could talk about that. When a sponsor goes and just basically underwrites a SPAC deal, they're the ones taking the risk in terms of all the costs associated with that, the legal and the filing and all the administration. Am I correct?
So the typical SPAC structure is that the sponsor will get about 20% of the outstanding equity at IPO, generally for a nominal contribution, and then they'll put in an at-risk contribution. They'll buy, usually warrants, on the future company that the SPAC is going to acquire, and that contribution will fund the upfront costs of the SPAC, from legal to accounting, and then also the upfront underwriting fees for the bankers who sell and market the deal to the public.
Okay, and then one of the things that you mentioned is that you saw a situation in 2000 and late 2019, early 2020, when they were trading above kind of intrinsic value. Because I guess at a certain point, wouldn't that be one of the worries on a kind of a SPAC portfolio, is that there is too much hype built into them so that they're trading kind of away from the embedded put?
So you can think of SPAC common equity with two pieces. One part is the zero coupon bond that basically represents the redemption value at the eventual liquidation deadline of the SPAC. And that part's relatively straightforward to value. And then the other piece we like to think of as the conversion option. It basically represents the right to own the company that the sponsor is going to try and acquire between the period of deal announcement and deal closing. Because if a sponsor finds a great deal that the market likes at or is willing to buy at or above cash and trust, if you already own that share, of course you have the redemption put, but then you also have the right to own this thing while the sponsor goes and tries to close the deal. And it's a really nice piece of owning SPAC common equity because you have this fixed income substitute, but then you also have this equity upside. And there's a whole bunch of different dynamics across various sectors of the SPAC universe as well. For example, if you've got a commodity SPAC and then a sponsor announces a deal in April, but can't close it till October, in some ways you have 6 months of embedded optionality on the underlying commodity. And that's also true more broadly with basically every company that's exposed to any sort of beta risk, where if the market's going to go up over the period of time, then you've got exposure to that as its comps trade up as well. It makes the deal look more attractive.
Right. I was actually thinking about this. If you owned a portfolio of SPACs that had not yet found their company, or their takeover, given this COVID kind of sell-off, wouldn't all the prices just reset lower in terms of what they're eventually going to buy? And isn't some way it's basically always just a call option on the future value of a company, and it doesn't, therefore there is no pin in it, for example, at today's prices?
Yeah, so that's an interesting question. I mean, it's really the SPACs that have a near-term deadline and have spent the last 6 months in negotiations with a target are in a challenging spot, because if all the public comps for that target have traded down, it's going to be a challenging moment to try and strike that same deal. So, in many cases, they may have to throw out a huge portion of their negotiations. But for those who have a longer term deadline into the future, and can sort of sit back and wait for things to shake out and see where the comparable companies' valuations settle in, there may be an opportunity to strike a deal at a more favorable multiple. And if you have time to get a better deal for your shareholders, and especially in this moment where there's probably a lot of high quality companies that need cash, a lot more anyway than a few months ago, there probably can be a lot of interesting deals to be had.
So where do you think the opportunities are going forward in the SPAC universe?
So, if you look at slide 1, you'll see this is just the current estimated yield curve for the SPAC universe. And you can see most of these things are trading at around a 2 or a 3% implied yield. And basically what that means is you're getting paid that 2 or 3% annualized on top of treasuries, which of course are very low on short-term rates right now, but you're getting paid on top of that to own this extremely safe security with the upside that the sponsor could find a great deal. So generally speaking, I think many of the best SPAC investments are sponsors that are affiliated with a high-quality financial or private equity institution that's well capitalized, has good deal flow, especially the sponsors who have done a deal successfully in the past. I think those are the guys who are going to have a higher likelihood of finding another great deal, especially if they've been through the format before and know what the pitfalls are. Almost universally, the first-time sponsors are surprised at the challenge of moving shares out of the hands of SPAC ARB funds and into the hands of would-be fundamental investors in the target company. And in this moment right now, VIX in the 40s or 50s, obviously it's going to be a challenging time to sell equity to anybody, but probably the VIX won't remain at this level forever. And so, the guys who are best positioned to sell equity and to finance deals coming out of it probably are in the best spot to outperform their place on the estimated yield curve going forward.
Right. So you brought us some great other charts, and you have this slide number 3, which is the front end returns, annualized return profile. Why don't you talk to that?
Sure. So this is basically taking a pretty simple quantitative strategy of buying $10 units at IPO, holding them through closing of a business combination or liquidation, unless the common stock is trading above cash and trust, and then selling the remaining components at the closing date. It might be hard to execute this strategy exactly because of liquidity concerns, but it's a pretty accurate representation of the returns that SPAC investors at IPO saw from 2015 through the end of 2019. And basically, you can see they saw about an 8.4 average annualized return, 8.4% on capital invested, which is pretty fantastic, for something with a measure of principal protection.
Right. Why do you think it was bigger for the bigger the IPO, the better the returns? Was that just skewed by 1 or 2 real big wins?
So I think what you're seeing there is the sponsors who are the best capitalized and have the most connections are the ones who are able to raise the largest amounts at IPO. And they have an incremental likelihood of finding a deal that the market's going to like better than cash and trust, something that could trade at $11 or $12 before it closes.
Interesting. That's wild. Okay, so let's go on to slide number 4. What is this showing?
So we took the front end returns from the last slide, and we basically broke down where each piece of it came from. You probably heard about the warrants, but some SPACs also offer rights as a part of their units, basically a tenth of a share if they close a deal. And just like the warrants, it'll go to 0 if they don't close a deal. I should mention, over the last 5 years, almost 90 or over 90% of SPACs were able to successfully close a deal, meaning the warrants that were a part of the units continued to have value after closing. We'll probably see that tick up in the coming months as some SPACs with near-term deadlines are facing challenging circumstances. But back to the slide, what you're seeing is of the 8.4% annualized return, almost half of that came from the warrant value, and then over half came from the common equity. But the yellow bar right there, only 11% of the total returns came from interest earnings on the trust account. So it's just interesting because so many of the participants see this as a fixed income substitute and as an ARB play, but the total returns to the space really came from the warrants from that red bar, which is when the common stock traded above cash and trust at the time that the deal closed.
Right.
Right. So those warrants are tricky because if there's no deal, they trade at zero. But if there is a deal, then they could potentially be worth a lot because a lot of times they're 5 years and plus, right? Why don't you show us what you got on this next slide in terms of the post combination warrant pricing?
Yeah. So the warrants are tricky because at the outset you've got this thing that represents a 5-year call option on a hypothetical future company, and it's a binary proposition where it's going to be worth zero if they can't close a deal. And so in many of the best outcomes, the warrants have done spectacularly well. And there's usually the company's usually allowed to call the warrants for redemption if it trades over $18. So there's sort of a cap on the eventual value. But the question is, what is a 5-year call option on a $10 company worth? And Black-Scholes would probably tell you it's worth something like $2. In practice, it's traded a little bit below that, which is the reason that we put together this chart, which is the warrant price against the common stock price for all SPACs that have closed deals in the last 4 years. And you can see there's sort of two classes for this chart. SPACs where they were able to close a deal with a low level of public redemptions, the blue dots, less than 50%, and then SPACs that had greater than 50% public redemptions. You can sort of use that as a proxy for, in many cases, was a SPAC extremely successful? That is, were they able to hang on to most of their trust account? Anyway, the reason we separate...
Ben, 1 second. Let's just explain that because I'm not sure I quite understand. So they come to market, they get $200 million of, let's say they raise an IPO for $200 million. And then you're saying the public, if half the people want to redeem and then they only actually go buy assets worth $100 million, is that what you're saying there?
So usually what will happen is the sponsor will find a deal and they'll try and market it. They'll go on the road, do a road show, and try and sell the deal to fundamental investors in the space. And they're also trying to sell the deal to the common shareholders and convince them not to redeem for cash and trust. But if the market doesn't like the deal enough to buy it above the amount of cash in the trust account per share, most of the common shareholders are likely to redeem. So the sponsor's real challenge, along with the operating target, is to move those shares into the hands of would-be fundamental holders in the target company. And really the best way to do that is to hopefully announce committed financing at the time you announce the transaction via a private placement. Deals that have a private placement that demonstrate committed capital, particularly from a name brand financial institution, tend to do pretty well. It goes a long way towards convincing shareholders not to redeem for cash, especially if you can do a pipe at or near the $10 cash and trust figure. So what you're seeing again is the SPACs that were most successful in convincing shareholders not to redeem in blue, and their warrants have actually traded like something representing a Black-Scholes curve, whereas SPACs that had greater than 50% redemptions have had a wider dispersion in what their warrants have ended up being worth for a variety of reasons. Either they were unable to register the shares underlying the warrants, or maybe they had a low-priced pipe where the market wasn't necessarily willing to value the warrants commensurate with the common stock, or a whole bunch of other possibilities.
So, Ben, you talked about it. You touched on this briefly, the fact that the company can call the warrants if the stock trades high enough. This is something I was just made aware of with the Virgin Galactic because they've had such a successful, SPAC issuance that it traded above that cutoff point, and now all of a sudden the whole nature of the options or the warrants trade changes, right? Why don't you speak a little bit about that? And can you don't use Virgin specifically, but typically I understand that the structure is all the same, that the company can force the conversion of warrants. And why would they want that?
Yeah, it's basically to limit the ultimate dilution of the warrants to the eventual company. I think the view is if you can deliver an outcome where the common trades at $18, which is a typical warrant redemption threshold, then you've given warrant holders a pretty successful outcome, and they want to be able to limit the eventual dilution to the target company. So they give themselves the option to call those warrants for redemption, which basically forces warrant holders to exercise, and it just cuts off the ultimate amount of dilution of the company.
Right, but it's kind of tricky math. It's not quite this as simple as just making everyone redeem at $18 sometimes, right?
Well, I think Virgin Galactic did it in a way where they forced redemption for shares.
Right.
I wasn't actually that close to that warrant redemption. So I
Yeah,
don't know
you don't need to
exactly.
speak about that one exactly. Why don't you talk about just in general when they make you take shares as opposed to getting any more money? Is that because they don't want any more money and they would rather you just have the shares, or is it because they're trying to limit the total number of shares?
I think every company's probably got their own individual calculation on how they want to do their cap table.
Right.
I don't know that I can speculate on how each one is going to handle cash or cashless redemption.
Right. But it is something that people should be made aware of because it definitely changes the pricing of these warrants completely. If you have a 5-year warrant and you're sticking it in Black and Scholes, and meanwhile it's got this $18 cashless conversion that they can force on you, it's a dramatically lower value that you should be paying for that warrant.
No, that's a really good point too. If there's a cap on the eventual warrant value of $18 plus sort of 2 months, because they can't really do it for 2 months after the stock initially hits 18, it is going to be an ultimate cap on the warrant value, and it's definitely worth knowing in advance, especially as you're considering these companies if they're high growth situations that have skewed probability outcomes where they might end up going sky high.
So why don't you tell us a little bit about yourself? Like, how did you come about being interested in SPACs and making this terrific website?
Sure. So I have a background as an equities trader. I got started at a prop firm in Chicago, and I've been trading for my own account for about 15 years. I've spent plenty of time in various ARB-type strategies, from traditional risk ARB to closed ends, preferred equities, and I've been focused on SPACs for about 6 or 7 years. When my partner and I got started, you couldn't even really find a list of SPACs that were out there, and we were spending so much time digging through the Edgar database, reading SEC filings. So really, we just built the product that we wanted to subscribe to, basically a comprehensive resource with every single quirk about every SPAC out there, because they're all different, and then with a synopsis of every single SEC filing throughout the SPAC's lifecycle. So we didn't have to go back digging through that 400-page merger proxy. We just go look at our notes and find, hey, here's the max redemption scenario for the deal, which is significant because, especially as you're trying to handicap the outcomes, the likelihood of closure, what you're trying to do is find how likely are they to be able to meet the minimum cash condition that the operating target has requested in connection with the deal. So again, back to the demonstrating committed financing at the time of transaction announcement, the higher the percentage of the minimum cash condition that the target has negotiated, the closer you are to closing that deal, the less of the trust account that you need to hang on to get it over the line.
So I'm a little bit of a computer nerd, so I'm going to ask you this. Did you program up the website yourself, or did you pay someone?
I absolutely did not. When we started this, I was under the impression that I was going to get it done myself. We ended up hiring a developer, coded it up in Clojure through run on AWS.
It is very well done, I must say. I went and I was very impressed when I went through and was previewing it. So listen, it's been a pleasure having you on, Ben. Why don't you tell people spell it out where they can find you, and I see that you can sign up for a free trial. Why don't you walk people through this?
Yeah, so if you just go to spacresearch.com, you can see our homepage. You can sign up for a free trial right on there. You can see our SPAC index. It's got every current U.S. SPAC in the market. Again, we follow along with, in real time, a synopsis of every single SEC filing and press release throughout every SPAC's life cycle. We got a whole bunch of interesting tools to sort and filter the SPAC market. And then I also write a weekly newsletter, usually a data-driven kind of study, like the charts that you've seen here in this chart book, trying to highlight whatever we're looking at in the market at a given time. So spacresearch.com, you can email us at info@spacresearch.com if you have any questions. And I hope to see you there.
Well, that's terrific. And as I say, it's widely viewed as the must-go-to research place for SPACs. So check it out. Thanks a lot for being with us today, Ben.
Thank you, guys.
Okay, this is something for a first for us, but it's our pleasure to welcome to our show the first anonymous guest, the man behind the immensely popular Twitter account of The Long View, which is, of course, Hayek and Keynes. Hayek and Keynes was ranked one of Business Insider's top 125 on FinTwit and has over 80,000 followers who turn to him for shrewd market content. He wishes to remain off the radar, so instead of using his real name, we're going to call him John, after the famous John Maynard Keynes. Thanks for being on our show, John.
Hey, thanks for having me, guys. I appreciate the opportunity.
Yeah, it's great to have you. I've been following you for some time. I found your Twitter content just outstanding. Why don't you tell us a little bit about yourself? Like, how did you get into the business? Where did you go to university, and what was the journey towards finance for you?
Yeah, I went to Southern University. A lot of state schools down here give pretty generous scholarships. I didn't come from a wealthy family, so my dad said, I'll give you $5,000 or $10,000 for college if you want to go somewhere fancy. That's on you. It's like, well, you know what? I'll stay here. So ended up getting a free education. They had a nice couple good programs in finance. So enjoyed that. Worked at a asset, institutional investor with an institutional investor. They were sort of shaking up the portfolio at the time, and got exposure to a lot of different strategies, different segments of the market. Came across, I realized I kind of liked global macro. This was before the financial crisis. I had an interview with Bridgewater. They initially told me no. And I said, well, I'm pretty sure I'm qualified to work there. They said, well, how about you apply for this job? So I applied, ended up getting an interview there. Everything went well. I actually had another offer, so I was actually kind of straightforward with them. I said, I need to know by tomorrow whether or not you're going to hire me, because these people have given me a 2-week window. I told them I was still interviewing, and they said by the time the plane landed, they had the offer. So it was a pretty exciting day. Went up there for 2007, 2008, 2009. It's kind of an interesting spot. My office was right under Ray's office, so it was like literally right above my head when I was there. Bounced around at Bridgewater for a while. Got kind of, I don't know, it just wasn't for me. Incredibly smart people.
Yeah, can I ask you a little bit more about that Bridgewater experience? Because, people are kind of, I don't know if everyone knows, but their kind of brutal honesty is kind of notorious in the industry, or not notorious, famous, let's call it. And I was wondering whether you experienced that, and if it really is a different environment.
It is very different. They do a fantastic job of hiring incredibly smart people, people that are able to question and really see through poor logic and maintain like a great level of consistency and thinking. So 100% agreement with that. And they, even their portfolio positioning shows they have a lot of mental plasticity. They can change their views as information changes. So 100% agree on that. I think the culture has some struggles just operating in a world of, if you have people that are at least when I was there, Ray valued people that lived by the culture. And it's a culture that works best when applied selectively. So if you acted like you believe the culture, you're going to piss off. If you actually do what the culture requires, you're going to piss off people, which isn't good for anything. Going and just sort of attacking people all the time and telling them they're stupid, or I think your ideas don't make sense or whatever. But if you selectively do it, it actually is very effective, because then you get all the niceties that come from selectively playing a culture. And then strategically, like throwing the dagger in. I saw that a few times there. So I think that's probably the drawback. And it does favor maybe slightly autistic people sometimes. Emotional, your EQ might be a little impaired in some situations.
So it's a little adversarial, is it?
Yes, unfortunately, and I think Ray, at least I've got friends that still work there, and some that have worked there since and left. I think they've done a better job of recognizing that delivery, as much as people might not want it to count, does count. Like, people are going to, what's that quote? It's not what you say, it's what people hear, and I think there's no way really around that. But overall, it's a great place to work. I would definitely not undo going there. It's a great proving ground. So
for sure, it's one of the, if not the best hedge fund in the world. At least it's the biggest in terms of assets under management, and I'm sure it was terrific.
That was before all the withdrawals from the
the Saudi the Saudi wealth funds. So then from there, you kind of had a moment, a little bit of a midlife crisis or quarter life crisis, as it's sung in that song, and you decided that you wanted to kind of question what you were going to do, but you eventually ended up back in the finance world. Why don't you talk to us about how that went?
Yeah, after that, it was after the financial crisis, everything was cheap. I had a little bit of money, and so, I was young. I was, in my 20s. So I was like, oh, okay, let's go travel some. So, kind of wrote out a bucket list of things I wanted to do, knock that off, did a multi-month cross-country trip. And, also, I think part of working at Bridgewater, seeing Ray was very accessible, and as were, some of the senior members, and money value really changed. And so I really just didn't have the same desire and ambition that I did after I left. Like, I didn't really care to be rich or powerful or whatever. It did philosophically change me quite a bit. And I actually considered going into teaching for a while. I did that, and I realized that it's not particularly. So I actually was getting a master's degree in education, and realized that, one, I'm probably not cut out to be a teacher, but two, just the education system as a whole is not set up for human beings to do the things that are needed to be done. So I've got a great appreciation for people that pursue that, and I ended up going back to the sort of institutional investment world. I realized that's what I really enjoyed from where I was at initially. You have exposure to everything. Since that time, I've been able to I've done everything from design sort of systematic and strategies on things like commodities with investment banks to sort of handling tactical trades and making recommendations based on market views to sort of selecting really interesting niche hedge fund strategies. So the diversity of opportunity that's available in the sort of institutional space is really second to none. Pension plans, endowments, sovereign wealth funds, foundations, these places I think really offer. If you can get on a place with more than a few $1 billion where you can actually write meaningful size checks, you kind of have the opportunity to work with a lot of interesting people, do a lot of interesting things, and learn quite a wide range of subjects.
So why don't you walk us through what your days look like these days? Are you basically getting pitched all sorts of different ideas, and it's your job to help recommend which ones you should be investing in? Yeah, so different places. I think endowments tend to work a lot like that. Sovereign wealth funds, pensions, maybe more on the others, and then and family offices as well are more on the sort of let's have a strategic vision, and then you kind of pencil in what your strategic asset allocation is, and then within that framework, you're going to have sub strategies that meet or sort of fit with your goals. And so I think my day-to-day life is really outlining the overall vision and strategy for the portfolios that I cover, and then making sure that we're identifying high quality managers in those spaces, and then reviewing the managers. Nick, there's I think it's Nick at FP or whatever. I think a couple of years ago he had a great tweet. He was like, institutional investors are just glorified HR, and in a lot of ways that might be true, because we are effectively just this sifting through like reams and reams of candidates. But I think there's quite a lot of skill and learning that goes into identifying like the true high quality the manager. So basically half my time is split between manager selection and then sort of asset allocation research. So I got a team of people here. We each we have assigned each of them coverage areas on asset classes and regions, and then a few people do specialties, like political coverage or just strictly central bank policy coverage. And so we meet weekly, make our internal reports, and then eventually make recommendations. And so between those two things, I stay pretty busy. So why don't you talk to us a little bit about your Twitter account? As I mentioned, it's one of the most popular on FinTwit. What is the benefits of doing it, and what do you find the kind of the positives in terms of the feedback that you receive from it?
Well, I guess from realistically from a personal level, people like to have like the ability to influence things. So it is kind of nice. I can tweet something and say, hey, 80,000 people just saw it. I don't know how many people actually read it, but there is like a personal element that's kind of nice from that. But the bigger issue, and the reason I guess I keep doing it is because, I guess this is in the spirit of Bridgewater. You can tweet something, and the things people hate about Twitter is all the trolls, and there are a lot of stupid people out there, but there's also quite a lot of really smart people. Most of them have, are kind and nice and thoughtful, and they'll just tell you, no, I think that's wrong for these reasons. And so the ability to effectively stress test what you're thinking is pretty nice. So I just like the fact that I can say, and I can ask questions too. I can say, hey guys, I'm looking at this area. What do you guys think about it? Or and it's kind of nice too. I like I recently got engaged. The girl, she was like, "Hey, hon, what are some good books?" And I was like, "I don't know." She's like, "Well, you ask your Twitter followers." I was like, "Okay, fine." So I did, and then a couple hundred people comment. So it's just kind of nice to be able to. There's just small perks, big perks. It's just it's nice.
Right. Okay. So the other thing that I've seen you kind of talk about is the fact that people forget that there's only a few trades in the world, like meaning that stuff is more correlated than most of us understand. Why don't you walk us through your thinking on that basis?
Yeah, I mean, we've all heard the phrase correlations go to one, when there's stress periods, but correlations are very close to one, or positive or negative one on a daily basis. I mean, if you think about every asset class, there's a risk on and a risk off proxy. You've got yen, you've got the 10-year bond yields, you've got utilities versus financials if you're doing a sector trade. And if you chart these things together, it's just one giant macro trade. And honestly, most of those things correlate pretty well to PMI. And so, most asset classes follow this. If you take gold, I mean, it's basically real yields plus the dollar impact. And, people it's always amazing. People get super caught up in, one versus the other or this and that. It's like, it's ultimately just the relative value within those trades. So sometimes like the sector-based trades in equities might be more attractive than the outright rates trades or something like that. But ultimately, I think people imagine a great more diversity in the world than there really is. If you want to get diversity, you have to move to more RV trades. And I think that's where the difference in like really average traders and really thoughtful traders can differentiate themselves. And you can do it through options, but that's it's just
so for people that aren't familiar with RV, you mean relative value. What would be an example of that strategy?
So if you wanted to isolate like some idiosyncratic risk, so like the most pure, most niche example are going to be like an equity market neutral hedge fund. So those guys are going to focus on a specific sector. Typically, you're going to have a portfolio manager with a small team, and he's going to go long Facebook and short. Actually, just not a great. He could go long like like Zillow versus Trulia or something like that, or Twilio, whatever. I don't even know if they're still separate companies, but financials is an easy example, like Bank of America versus Wells Fargo. That's an actually really easy example, or JP Morgan, based on the relative value of the two trades. And there's still going to be macro factors that derive that, particularly if you drifted further and further away from the specific. So if you went from like a bank versus a financial company, okay, then you've got like some, maybe some reinsurance risk or some catastrophe risk. You've got maybe some net interest margin. If you did two banks, maybe one has more of a mortgage business and one has more of a commercial base, or one was more investment banking. But there's some variables there that are macro oriented. But for the most part, the day-to-day risk doesn't have anything to do with markets. It doesn't have anything to do with risk on. If one of them might have a slightly higher beta or something, and you can adjust for that. But the true idiosyncratic risk is what shines through. And if you hear like any equity market neutral guy, they're always going to say, how much idio risk do you have? How much idio risk do you have? And that's really where the magic happens, I think, in the ability, if you want to build a truly high sharp portfolio, you're going to have to focus on that idiosyncratic risk. You can diversify your beta with something like risk parity, and then you bucket all your, you have your growth bucket, your, pro-growth, anti-growth, and pro-inflation, anti-inflation sort of buckets. But for the most part, you've got, I guess you also have insurance, I didn't mention that one, but reinsurance is one sort of uncorrelated beta, but that's not accessible to most investors.
Right. So now when you're thinking about making a portfolio and you're thinking about this problem about everything, the correlations are much higher than we all expect, what goes into making a good portfolio manager that designs a portfolio that is actually different than the rest?
Well, and this is why I like where I'm at, because I can work with people who do it better than me. The first thing you're going to have is really good risk systems, and even like semi-solid risk systems like Bloomberg don't work well for, if you use Bloomberg Port, for instance. A lot of equity managers would use that, but that doesn't work well for multi-asset portfolio. Is not going to handle things like commodities. So first thing is having a good system in place. And then the second thing is, if you don't have a good system, fundamentally bucketing the risk as, sort of, I think the all-weather framework is probably a pretty good starting point of having, okay, these are risk-on assets, these are risk-off assets. I think that's the most sort of generic. I feel like everyone should sort of know that. And that's sort of the genesis of the 60-40 portfolio. But the problem there is the risk of your two halves is not nearly equal. So the risk from your equity piece is, going to dwarf the risk from the fixed income piece, just because the relative volatilities are so different. You have 3 to 4 times the risk. If you're not trying to design like a regular sort of investor portfolio, if you're trying to make sort of like a long-term investor's portfolio is going to be long some sort of version of risk assets. The other way to do that is to just have like very simple and generic like limits on portfolio concentration. So I think this is something I struggle with broadly, is like what's available to individual retail investors and what's available to institutional investors. It's just night and day, the robustness of portfolio construction. And I just feel like trying to generate alpha without the tools that are available is sometimes a little bit of a fool's errand.
But do you think that sometimes that actually bites the institutional investors in the ass? Like in that when you go look at a strategy like selling volatility, that looked like a great Sharp and it looked terrific. And ultimately it's cost all those investors huge over the last, 2 months. Is this something that it might be a case where you'd be better off keeping it simple?
Well, it just depends on how you define risk. So if you define risk by the standard deviation of your asset class, then the classic volatility of the asset class. There are plenty of assets that don't have any volatility. So I think reinsurance is the best example. It doesn't have any volatility. You make plus or minus 50 basis points a month. During hurricane season, you might make 1 or 2% a month. And then every once in a while you lose 30 or 50%, depending on how your catastrophe risk is structured. And that is not going to be captured by traditional risk metrics. And so I think like VAR for these high left tail strategies is a better metric. So you think about like something like fixed income RV. We just had some troubles as the treasury market was dislocated this past month. Very, very high Sharp strategy. If you look at the whole universe, it's like a 2 Sharp strategy. But obviously, occasionally you're going to lose, 10, 15, 20% or 30 if you're not very prudent with your leverage, or you're doing more bond versus bond basis as opposed to bond versus futures trades. And when that happens, you're like, well, how did this 2 vol strategy lose 30%? Well, it wasn't a 15Z move. It was just that it was a highly skewed distribution. And so recognizing that, and that's the problem with most RV trades, is that, if you think about like the stock versus stock example earlier, like Bank of America versus Wells Fargo, like that trade is a 3 or 4 vol trade, except when Wells Fargo gets sued, or when, no one's going to buy out Bank of America. But if there's a buyout, obviously that stock's going to go up 20 or 30% in that day. And so that's a very left tail move. And so I think the only way to get around these high VAR trades is to limit the amount of risk that you have in a trade. And so for short vol, if you're buying like one of the inverse VIX ETFs, you had to expect that thing to go to 0 at some point. So you never allocate more than 5% of your risk to that trade, because that that's a capital intensive risk. For a reinsurance trade, that one day you're going to lose 30% of it. So you don't think about standard deviation, you think about the tail risk. And I think that VAR bucketing or tail risk, sort of losses I think the proper term is CVAR. That's how banks talk about, risk after the financial crisis. But thinking about it in that context is probably a little bit better way to think about the risk that's in a portfolio. So if you've got your risk allocated across, an ideal hedge fund would have its risk allocated across a bunch of, RV trades or macro trades, knowing the VAR associated with them, and then the underlying correlations of those trades, and not only not normal periods, but also stress periods, and then limit gross exposure, limit the underlying market exposure.
Right. So this brings us to kind of the current crisis. Let's chat a little bit about that. I know that after 2008, there was many of those VAR simulations that tried to simulate the great financial crisis. And I always thought to myself, why are they doing that? That was a once-in-a-lifetime experience that we were never going to experience again. And it ends up being that I lived longer than I thought, because sure enough, we've had another once-in-a-lifetime experience. And I was wondering what you think about this huge shock and what it means going forward for investments and how this is all going to play out.
Well, the economic shock is clearly massive. I don't think the equity shock was all that surprising. I've got Bloomberg open here now. I'm going to go to the last year. I mean, equities are where they were in October of last year now. And if you look at except for the very short, brief drawdown, I mean, they were down The problem, I guess, with looking at any sort of like drawdown level is that like basically we had a massive run up from 2,800 from the lows of in October and August of last year
Right.
to 3,400. And so
would you not argue that the actual more of the stress from this one was in the credit markets?
No, I wouldn't.
No?
That actually came later. So the first stress, if you look at the way that the market sort of was shocked, the first shock was you had spot gamma on here. The first shock was a combination of gamma and CTAs. CTAs were max long, and they've been max long. If you can see our tweet about that. I got burned on that trade from January to March. It took much longer to roll over than I expected, and a lot of that had to do with something I didn't appreciate at the time, which is why I started looking at the structure ball as the sort of call overwriting process that just created the gravitational pull higher and higher and higher and higher and higher. And then eventually people didn't buy calls anymore; they rolled them into puts, which created the downside pressure. So then, obviously, when you had that shock from Italy happen, then equity sold off. Gamma exacerbated the move, and CTAs began to liquidate. That was the first leg, and that was probably a 10 or 15% move at that point from 3,400 down to 3,000. Then you had nervousness because obviously the economic toll kept getting higher and higher and higher as cases exponentially grew in the U.S. So people, because it's a 5% GDP hit, it's a 10% GDP hit in Q2, it's a 15%, and then obviously oil began to suffer more and more and more and more as people realized more and more people were going into lockdown. And then the Saudis announced in Russia that they weren't going to cut. Well, at that point, it really didn't matter what they did. I mean, you're talking about a 1 million barrel a day shift in global supply. But you have, 10 at that point, closer to 30 billion of supply offline now. It doesn't really matter what they do with that 1 million barrels a day. But it became the catalyst for a large move in oil. When that happened, that's when the real panic started. So if you look at the timing, it was equities and then oil, and then the third leg was the dislocation of the treasury market. And that was when we had an equity market move combined with economic fears coalescing around a financial problem. And that was when we really shifted from one issue to something that became much more problematic. And so when the treasury market was dislocated, I mean, if you think about, we were talking about hedge fund RV trades, that's the classic one. That's what took LTCM under, but the treasury market became very dislocated. So if you just think about a 9-year bond, a 10-year bond, and an 11-year bond, years to maturity, the 10-year bond is going to be where the futures contract is at. And so people, oil falls, inflation falls, it was a risk off moment as well. So people are just naturally buying treasuries. Well, the people buy the futures because that's what's liquid. People aren't buying a 9-year cash bond and an 11-year cash bond. So people that had on RV trades, which were actually pretty rich at the time, they got the futures gets bid down. The cheapest to deliver bond gets bid down. And if you had an RV trade on with a 9, 10, 11-year bond, you got wrecked. The level of dislocation was similar to 2008. That within a few days. And then there's also been more money in that space, and so you had massive leveraging. That's when phase 2 happened. So Millennium and others, they kind of killed their pods, different managers. You can read about that in the Financial Times. Then that begins a process of de-risking. And so then some of the RV trades we were just talking about earlier in equities, those managers begin to degross. So someone like, like the fixed income guy loses money. Well, Millennium as a whole is losing money. So then they have to draw down money. So then they bring in the risk. And so they tell the RV guy in equities to degross. Well, he's degrossing. Well, he had losses because the rate sensitivity flows through lots of assets and sector trades as well. So there were some losses there, but the bigger issue came from that. And then there was also market makers that withdrew. So you like Rodin blew up. I mean, I could see that in my PA. I always thought I was being cute selling some covered calls on some distressed names. They would have ended up playing out, but for a few days, there was no bid on some of these options. And so the equity guys obviously were getting wrecked as well as they were degrossing. So typically what happens in the equity degrossing period is quality gets dumped and trash gets bought. And you couldn't hedge because the vol markets were wrecked. I mean, vol was at 80 anyway. And so you had the timing was basically equity dislocation, oil dislocation, fixed income RV dislocations, and you had equity degrossing. And eventually you had CTAs have been selling the whole way down. They went from basically max long to flat, slightly short by the bottom. And then retail panic selling near the bottom. I could, just my anecdotal friends were, anecdotally people were calling me like, what do I do? What do I do? Do I sell? I was like, well, don't sell. If you're nervous, shift. They were in target date funds. I was like, just shift to a target date slightly closer to your date. Go from a, 20, whatever, to shift it 5 years forward. That'll reduce your equity weight. That's the cleanest way to do this. If you're nervous, don't sell out. And so obviously, I wrote about it on the blog, policymakers came in and then really changed the narrative and said, okay, well, we get this minus 25% for a quarter divided by 4, minus 8%, hit the GDP, or 7% hit the GDP, whatever that number is going to be for the full year. They came in with 10% policy stimulus, and the Fed basically rolled out the GFC playbook in a week. They fixed with unlimited QE and repo, they fixed the RV curves and Treasury, so that released some pressure. And then from there, once the Treasury market started functioning, tips got dislocated. You can see that. And then credit markets, they were selling at a discount. They immediately snapped back. And then equities kind of got some breathing room after that. And then even when Friday, they finally kind of recovered the high yield market. So in a lot of ways, the whole process was equity shock, financial dislocation, and economic fears, the Fed fixing that. And then sort of the mend has been happening for the last 2 weeks.
Well, that's a great summary. Now, what do you think about the LIBOR market? Because it's one of the front end of the kind of funding curve is still showing some signs of stress. Do you anticipate that that's just the last to come down?
I will fully admit that I am not an expert on that. But the SOFR curve was a little dislocated. I know that's where we started this transition to, and that has largely that's really not been dislocated at all. I mentioned, I tweeted about there was some, you could see stress in U.S. banking spreads. That was also elevated, and somebody highlighted that, well, if the way in which they calculate that's elevated a little bit more. There's definitely going to be some stress within banks. I'm sure people are nervous about the credit risk associated with banks. So, I mean, they're clearly lending out. They've got all these open revolvers. People are tapping them, saying, give me cash. And they don't have cash to unlimited amounts of cash in the U.S. The Fed's trying to fix that. But, I mean, there has to be some residual nervousness around the sort of quality of the financial system, just given that, I mean, it was several $100 billion. It was the most it had ever been tapped in a month. And so, I mean, people are just locking down cash. So clearly banks are a little strapped. You've got credit risk outstanding. You had that balance sheet impairment with AAA assets. That was the other thing that happened too, is when oil hit, and that precipitated the credit spreads blowing out. But you also had forced liquidations, which is when the Fed sort of opened up their catcher's mitt to take off assets. And I forget the acronym they use for that one, but basically they're saying don't sell your AAA assets in the market and screw up the leverage, of everyone else and knock down asset prices. Give it to us and we'll give you cash. And so that alleviated some of the selling pressure in markets, and then that freed up some more capital for banks where they weren't in this forced deleveraging. I think it probably was more acute, probably from outside the U.S. If I had to guess. I know Japanese investors and other investors were pretty heavy in the AAA CLO market, and that was one of the areas where some of the dislocations happened. So it wouldn't be surprising if you had some forced deleveraging from asset impairment that sort of emerged from all that process. I think it gets straightened out. Central banks are trying to fix it, but that's going to be lingering for a while.
So it sounds like this. Oh, sorry, Patrick. Let me just ask one last question.
Okay.
One last question, Patrick. So it sounds like to me that the central banks have been more on top of this than the 2008 crisis. Do you think it's enough, or do you think it's too much?
I think it's likely it's enough to avoid. I saw Ray came out with this sort of depression, piece this yesterday or the day before. I think that it's certainly enough. If it were just talking about developed economies, it's 100% enough to avoid a depression, because the magnitude of the shock is somewhat. Hopefully we know it won't last more than 18 months. Hopefully it only lasts a few months. We can get back to work. We can do testing, and meanwhile we're building herd immunity. That said, it all depends on how long this lasts. But if assuming this lasts 2 months, assuming we all just locked ourselves in a house, we ran at 50% GDP in the meantime, that's basically just say 10% shake off for the year. That plus the financial system working, you throw free money at it. If we can get back to work in 8 weeks, the totality is enough. Now the question is, does it linger? Is there a second wave? What's the long-term impacts? The unemployment benefits, where you think where the long-term problems would happen if the job market's dislocated, the unemployment benefits last 9 months, and they're actually somewhat, you could argue, they're actually stimulative. And that's also where, if you look at where job losses are concentrated, it's been on low income. So it's easy to pay for people who make $20,000 or $30,000 a year. It's much harder to replace those $100,000 a year white collar jobs. Those haven't been lost yet. So there's a lot of uncertainty. I think we come out with a limp. The question is how bad, and that's really a question that has more to do with the virus. It seems like there's been a lot of progress there in the last few months, so I'm optimistic. But I think they did an amazing amount of stuff. They did it in basically the GFC playbook plus some in 2 weeks, plus a 10% stimulus, like World War II level stimulus. I mean, it's a phenomenal level of response. I'm totally blown away by how much they've done.
Right. So, John, I want to go back to, okay, so you basically alluded to the idea that the Fed basically came in and saved the day. The catcher's mitt, they basically came in there and an avalanche started down the mountain, and they basically came in there and they threw everything at this, and they were able to at least initially create the stability that's created this reaction. Now, throughout bear market history, often bear markets have these bear market rallies, and obviously there is a lot of people, including myself, that have the view that it doesn't just end in a month. Like there's knock-on effects that simply once this kind of big massive margin call happened, it takes a while to establish the base from which a new bull market can actually develop. I mean, do you share that view, or do you think that this could be like a more of a V-shaped recovery if there is not a second wave? Like, obviously, there's a lot of unknowns in terms of will the coronavirus keep things shut down for 6 months or a year? But what's your take on how this all plays out throughout 2020?
I think if this is relatively short-lived, I think we put in the lows. If this drags on and there's like permanent long-term employment issues and equities trade sideways, in the past there's always been an alternative asset. I mean, like treasury yields and bond yields treasury yields and equity yields have always been pretty similar. The Fed model, I mean, they just sort of floated together. Right now you're looking at, he's got an egg on his face for saying it, but cash is trash. Now bonds are trash. Commodities are uninvestable for the next 3 to 6 months with the contango, with the curve. And I just don't see people pulling out all of their money out of equities and sitting on it like an egg. I mean, maybe they do. Maybe people are that worried. But the second point that makes me, I actually was more in the camp of we'll go lower. But the second thing, I saw Mark Dow, he did a Twitter survey and he had like 50% bearish. And I was like, I wonder if his people are just different than my people, followers. And I said, well, let me just do a little survey. And it was like 5,000 people. And, similar, almost identical results, like 30 or 40% said, no, we'll make new lows. And so I feel like if people were that bearish, they've already sold. And knowing that, the people that have called me, want to sell. Again, I feel like this is that sort of lower part is all predicated on the fact that we don't have a more massive economic shock, but you basically got 40% off in a lot of sectors. You have no alternative to invest, and you're looking at, even if you have a significant impairment to earnings, permanent impairment to earnings, you're still looking at 3-4% earnings yield in a world where the treasury yields are some 1%. So right. It's still a pretty attractive asset allocation call.
Right. So, John, it's Kev here. I'm going to hop in. When you look at the investment landscape right now, one of the things that you've kind of harped on is the fact that China is a worry. Why don't you walk us through your thinking there?
Well, if you look at global PMIs, China leads global PMI by about 9 months. And so it's been the engine of global growth. There's a 20 or 30% contribution to global growth. And they've done that through really several measures. I mean, the first one has been taking farmers and then converting them into worker bees. That process is largely complete. They also did it by having very cheap wages. Those now are much cheaper to employ people elsewhere. The second thing is the urbanization process. I mean, you can look at the map of Beijing or Shanghai and then compare it to a map of Rio de Janeiro 20 years ago, and then you look at the same map for Rio today. There's like one extra line, on the subway, And then Beijing looks like a spider web or whatever. And so the development that went into that also came with a lot of debt that can't be repeated. If you look at the demographic headwinds, the workforce has been growing for the last 20 years, is going to start shrinking. They've largely adopted Western technology, stealing it or adopting it, whatever you want to call it. Typical solo model. That process is over. So they're at the point now where they can still adopt some things, but they're largely like, Korea and all the major cities. They're developed economy, sort of on the edge. They're, sort of copying our Amazons and Googles and stuff like this. So there's no sort of running up, employing basic technology to advance your GDP. And then the banking system is highly levered. The sort of government stimulus is largely tapped out, and interest rates are pretty close to zero. And on top of it all, you've got a massive housing bubble that's 1% to 2% cap rates. So I just don't see how all of this plays out in a way over the next 5 to 10 years, with China delivering the same level of growth that they have delivered over the past few years. And if you take 300% debt to GDP in a world where you have massive asset bubble, it's just very difficult to see how you continue to meet the debt service needs and obligations of that debt and continue to grow at a level that's sort of necessary to meet your long-term goals. And it just seems like a very tenuous structure, all while maintaining in this low-growth environment, keeping capital trapped and not having an exit.
John, it's been a pleasure having you on. Thank you very much for your time. For those who want to learn more about Hayek and Keynes and his views, make sure you follow him on Twitter at Hayek and Keynes, HayekAndKeynes. Thanks again. Time for the rest of the show. Lena, hop on.
Hello.
Hello.
Thank you for making me work on a week. On a
Lena,
holiday.
everyone talks about how great your voice is, and then they say I sound like Kermit the Frog or something. Lena's got this like sultry voice and great laugh, and all I get is that I sound like a Muppet.
I may sound like this, but people don't know what I look like.
And Patrick, by the way, everyone thinks we sound alike, so you sound like a Muppet too.
That's by default. That's funny. Okay. Listeners should be warned that we just finished 3 interviews before we got to this, and so I'm already on my 3rd IPA.
Exactly, one beer per interview for Patrick. That's his regular.
And well sloshed.
when
we make fools of ourselves in the next half an hour, then everyone be warned, right?
So Patrick is speaking for himself and not for the rest of us. Who is our sponsor this week, though? We don't have one, do we, folks? But we all have individual sponsors. Who's got what? Lena, let's start with you.
I had to break into the beers that I was saving, one of the sponsor beers, because I have nothing to drink anymore.
You're going ahead?
I have to.
You're going ahead?
I
what
had
are you
to.
Drinking?
It's a Good Friday, so I am drinking Big Spruce Brewing Company's Tim's IPA.
Oh, okay.
It's organic.
Patrick, what are you having?
Well, I've actually had 3 different beers. So I actually went to my I had a couple IPAs earlier, but now I actually went back to one I had last week, which was actually the Canuck Pale Ale from Great Lakes Brewery. So that's like my 3rd beer, and that's the one I grabbed anyway.
So I too have been mixing. I started with a little wine because we started early in the day, and I figured it wasn't beer time.
It was wine o'clock.
It was wine o'clock, so I had some wine. My university-age daughter had left some white wine even, so I had that. It wasn't as bad as I thought it might be. But then I've moved on to Bowles Falls Session IPA, Bench Brewing Company.
Nice.
Crafted in the escarpment. I think we had them as a sponsor before. I think there's a leftover remnant that we're all basically raiding the fridge.
Yeah, exactly.
It's getting pretty desperate times now.
Yeah.
Okay,
Let me do my legal stuff. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include whispering bear euphoria, explosive candlestick chlamydia, and or crippling junk buying cramps.
Oh, I would never want to suffer from any of those.
Okay, let's get on with the show. Patrick, it's time for you to shine. What do you got for us? Talking charts.
Well, listen, we have a long show, so we're just going to keep this super simple. What I wanted to really jump right into is just looking at what sectors did well this week. And obviously, the oil pop that happened actually caused, at least for the 5 days, a pretty big jump in the energy space. I mean, they were up over 20% on the week. But I mean, I always hate looking at things as a percentage basis off of a bear market crash, because anything that just remotely bounces looks like it's up 20, 30, 40, 50%. It's amazing returns, and it's nowhere near its highs, right? It's just It's just a reflexive rally, and just when you go low enough, the percentage, like a perfect example is that within Canada, or is now Oventive, the thing goes from like 20 down to 3, it goes, or $2. It goes from 2 to 4, and it's up 100%. Well, it's nowhere near 20. But it's just 100% off of 2. But anyways, the energy sector had a pretty big bounce. But what was interesting was the bounce in the financials, right? And the financials and REITs all had a pretty strong go in the last week. And I think that last wave of Fed stimulus, and you can kind of pine in on this if you want, but like it really created a bit of a reversal in many of those. Let's pull up the XLF here. And just show it, like, because the financials were dogging it, and all right up until last week, and then starting on Monday through Thursday, just a rip from the XLF went from $19 basically to 24. It was a huge run in the financials in just 1 week, right?
Yeah, and it was. I almost wonder if everybody knew, or the people who were in on the knew that this junk bond buying expansion from the Fed was coming, because it did seem like even all week the stock market was trading probably stronger than it deserved.
Yeah,
and then the news came out Thursday morning, that Fed was venturing into the world of junk bonds, and that just ripped everything higher. And
and look what it did to the REITs. Like, this is the Real Estate Investment Trust, the XLRE, but it went from $29 to $36. Just a huge jump. And I'm thinking about all the commercial real estate and everything that's in these REITs. And for them to have rebounded to this magnitude this quickly is pretty impressive. Like,
it's more than 50% return, right? Although, when you were telling us that line about that we shouldn't be using the percentage returns off the bottom, I actually almost wonder if we should be using the returns from the price on the way down. So, like, this thing went from 42. So if you think about it from 42, you almost keep that as your denominator. And think about it, we've rallied
15%.
But $8 on 42 is not the same. Anyway, it's just something to think about. But I agree. It's because unless you've been doubling down or I guess if something gets halved, you had to double down on it. The returns aren't the same.
Exactly. And the mortgage REITs were interesting as well, like those highly leveraged, like the Annalise of the world, which is one of the big boys. All of these mortgage REITs were getting so hammered because obviously the risks inherent in it. But again, with the Fed bailing out the mortgage-backed security markets and all these other things, the risks of these companies getting margin called massively diminished. And so all of them had huge rebounds off of their worst levels. It'll be really interesting to see if this establishes a core bottom in this space, right?
Yeah, well, the whole market seemed to bottom, and all those people that thought the world was ending must be very upset.
I'm a seller on that, but we'll talk about that when we get to the top 3 things to watch next week. The one interesting thing I wanted to bring to attention, Nat Gas, because you were all over Nat Gas with a couple of your macro tourist blogs. I wouldn't mind hearing what you have to say, but my view is that Nat Gas has had multiple fake out breakouts in the last 3 months. And every time it kind of popped and then it made a lower low. And what I'm dying to find out is whether or not Nat Gas, this on the last 2 sell candles, makes a lower low. Because one of the classic things that defines a bottoming formation is when the distribution phases no longer drive lower prices, which means it's like the price has found a new equilibrium where supply and demand is kind of at the right level. And so we had this pop higher after a little double bottom, and it's kind of coming back. Does it make a lower low? If it doesn't, maybe the worst is behind Nat Gas. What's your take on the sector?
Well, Pat, all I can say is from your lips to God's ears that's the double bottom, and that it's not going to make a new lower low. But obviously I'm bullish. I think that this is it. I think that when you go and you take the shale.
So how do you
oil
play
and
it? I mean, are you going right into the nat gas futures, or or would you take?
I
a
own
shot
the whole
on these-
strip. I hold the whole strip because I don't want to just roll the front month all the time. So I own the whole 2000.
You just did it, right?
Yeah,
but
I just
okay,
bought the whole
but are you
12-month
playing?
strip.
But are you willing to play it through natural gas stocks, or is that not worth it?
Well, the trouble about natural gas stocks is that they're stocks. Now, you might say that's a trouble, but actually, on the other hand, this week it wasn't a trouble. It was actually a huge benefit. And these things ripped higher. And Cuppy was giving me a hard time.
Well, look at Sandridge. I mean, this is it didn't move.
Yeah, but that's not. I don't think that's one of the ones that he looks at. Let me get his list up because he has a list of a bunch of stocks that he likes.
Chesapeake didn't. Ovintiv. Ovintiv moved off the low there. That was the
SWN, RRC.
So let's just go one time. So
SWN.
Yeah.
RRC.
Yeah.
Yeah, that's looking good.
Yeah, that's a
that's looking good. GPOR.
Yeah, Gulfport. Now Gulfport has been dogging it though. I mean, obviously, when you're coming off a 30, 40 cent low, anything at 60 cents.
Do you see that huge crazy candle there?
Yeah, what was that, by the way?
I don't know, but no such thing as a bad tick, baby. And AR is another one.
Which one?
AR.
AR.
Apple Robert. Those are the list he was sending me.
Nice.
Oh, look, so they're all doing it. He calls them turd bomb gases. And the bonds were all up 5 to 10 points, he said. You know what? I'm with them. Listen, it was probably a better play, no doubt about it.
You know what? I actually, my opinion on all of these is that if you buy them and just don't look, that there's an optionality to actually owning the equity down here, which is essentially at this point getting zeroed on a dollar equity. It's like a call option because if this thing doesn't blow up, these are all $3, $4, $5 stocks easily, and your downside risk is $1.
Well, there you go. Here, you guys heard it here. Patrick, 3 beers in, is deciding his investment advice is buy it and don't look.
Well, no, but like the thing is it's long as you accept it as a binary thing. If your risk outlay is you're accepting that as your max risk to zero, then you have it's asymmetric. There's more upside than the downside risk. You easily have more than 100%. It's easily 300 to 500% if you're right, and 100% loss if you're wrong. And with that kind of odds, if you had a 50-50 probability, why wouldn't you take it?
Yeah, no, you're absolutely right, Patrick. I was just giving you a hard time.
Well, yeah, whatever.
What's the third one you had list for us here?
Well, no, I just wanted to look at these bonds, and this is one of the interesting things. I mean, we're going to touch on crude oil when we start talking about the top 3 from last week and stuff like that. But I mean, is there still is the deflationary impulse still going to be dominant on the short term? Listen, I don't want to get it because I know on the long term you're like a monster inflation.
That's true. You know what? That's smart. That's smart. Let's just talk about the short term.
The short term, like if crude oil goes into the teens, because this was a thing, like if there's still one more deflationary impulse here, does that create this as a little flagging formation that still launches the 10-year higher?
So here's one thing I would like to just throw at all the people who tell me that QE is so bullish for bonds. How much is the Fed bought? It's barely moved the bonds.
Okay, you know what? Stop this. I am going to push back on your argument because ultimately when QE is not necessarily needed, it becomes inflationary. To me, I look at the QE that's been thrown into this market today, and it was just barely enough to offset the massive deflationary impulse on the other side. So I honestly think at this moment it's just like tit for tat. They basically zeroed out themselves. That doesn't create the inflationary impulse. To me, the inflationary impulse from QE that drives bonds lower is when they run QE much longer than they should. And they probably will. And so to me, I think there'll be a lag on your narrative, which is essentially, I think that right now, even if they're doing QE, that's not going to be inflationary, which drives bonds lower yet.
So Patrick, just want to let you know, it's not just my narrative. It's Stan Druckenmiller. So you fade him at your peril. I'm going to say this. I think bonds
I just
are
think
headed
you're
lower.
early. But Stanley's been early before. I just think you guys are early. You're going to be right. You're going to be right. I'm not telling you you're going to be wrong. You're just early. I honestly think that over the next month or two, that this trend can still persist longer, and then the real move, the opportunity at some point, shorting bonds is going to be a no-brainer. I've been neutral bonds for months now. I've stopped being a bond bull. I'm not a bond bear, but I'm not a bond bull anymore. And so to me, there's going to be an opportunity to short this. It's just I'm not there yet. I haven't taken a single position in bonds yet. Are you short bonds? Are you short in Treasury already?
Patrick, is it a day with the letter ending
Well,
in
you
Y?
but you have only two states. You're either short or you're neutral. So are you neutral or are you short?
No, I'm short. I'm always short, Patrick. It's like,
Jesus.
honestly, like the world has to be ending for me to get long.
Oh my! I'm not asking you
just-
to go long.
I'm just
whatever.
kidding. Not long, but
All right.
like neutral, to get neutral. Like
Anyway.
I'm just saying. And I'm just
Enough
making
talking
fun of it.
charts.
I'm actually, one second, Patrick. I'll just tell you. I like shorting the boons, the German boons, more than the U.S. ones. And I think that's actually a great trade. But anyways,
because the situation in Germany is that much more extreme, and there's so much more room for that velocity to come on the other side. If you're right, I'm not opposed to your idea. All right, let's move on to the top 3 things to watch next week. But before we do, let's get to the top 3 things we were watching last week and just quickly review them. So the Canadian unemployment rate and claims. Well, Kev, wow. I mean, they were expecting 427,000 jobs loss in Canada, and it came in over 1 million. And for our U.S. listeners to understand that, the Canadian population is 1/10 of the U.S.
That's right. So it's like 10 million there.
It's
Even
the
I can
equivalent
do
of
that
10
math.
million. Even you could do that math, I know.
Yeah.
And so that it was brutal. It was brutal.
Well,
and so
that's what happens when you send everyone home.
Yeah, it's true. And you know what? Well, let's continue this conversation because in the next week's top 3, we're going to talk a little more Canada. So but it was bad. It was bad. There's no doubt about that. So number 2, does the PBOC let the yuan slip down to decade lows? And they did not. Right. It's
to be fair, Patrick, I'm gonna stick up for you here. You said something to the effect that this is not something that's going to happen next week. This is something to be watching in the coming months.
Right. But also I think it has to do, I mean, they basketed against the euro and other currencies. And so I think that for them to let the currency go here, they would have had to, we'd have to see the euro and everything else breaking down all at the same time. Like the likelihood that this was going to go on its own was very unlikely. And so we had the Dixie dropped below 100 back to 99.5. It just wasn't the environment for the move to happen. But it's still, I think, something worth watching. We're still down at incredibly distressed levels on the renminbi, and I don't think it's something we have to stop watching. I think it's going to be something that's still playing out into the summer. All right, and number 1, oil production cut or tariffs or one big nothing burger. Well, it was something kind of a mix of everything, isn't it? Like
I would say that it was not tariffs, and although the cut came, it was probably a little less than when we were talking last Friday, right? Friday,
when you raise
market
the
was screaming-
expectation, as high as Trump did, it only offers the window for everyone to be disappointed.
Exactly. He just hasn't learned this game yet. And so we were both leaning towards nothing burger, right? And the thing was, I didn't want to say it because I didn't want to goocher it. And I didn't say it, and it was fine. So we were okay. So it proves once again, as long as I just keep my mouth shut, we don't agree in public, but together we're okay.
Yeah, as long as we don't do it in public, because otherwise, and we would ruin it for all the listeners too, because we have a bunch of listeners of this trade on, and they're like, Kevin and Patrick fucked it up for us. This is not good. Anyway, the crude oil though, back down to under 23, closed at 22.76. You know what my problem here is that if these OPEC plus little online meeting thing and their little announcement of the production cuts, which were going to happen irrespectively, played out and crude oil couldn't rally on that, what reason do you have of having any confidence in holding oil long? I honestly think that this actually could be the exact opposite and drive a break below 20. And there's just because everyone says, well, if this can't drive prices off of here, then what will?
So, Patrick, I think that we have to be clear here. We're looking at the front month, which is very quickly going to become no longer the front month because everybody's rolling. Do you know what this is May? Do you know what June's trading at?
Well, let's take a look.
Well, I can tell you.
No, I'm looking at the chart right now. Just we'll pull it up.
So, just for everyone listening,
June,
this thing May went off the board at around $23. That's not right.
No, this is CL.
Yeah.
So here we go. At 28.82.
Yeah. So literally, it's almost $29. 23. It's a $6 spread.
Yeah.
So we could have a situation, Patrick, where oil doesn't go anywhere and stays at, let's just say, $20 or $23, but that the market keeps having this monster steep spread, and you, as an oil long, just get chewed up something fierce.
For sure, because that June contract could head right back down to 22.
Yeah. Right. Like let's assume spot, Patrick. Let's assume spot doesn't change. You're going to lose $6 a barrel and over the next year, next month.
Yeah, it's brutal. And
so
unless you throw it on one of Cuppy's ships and sell it forward. Right, I mean that's what these shippers are doing. They're printing money, right? Like
it's not the shippers, for sure.
Their charter rates they can charge.
Well, I hear
because that.
People are even renting rail cars and just storing it there. I saw someone that was talking about the fact that Texas has something like 50,000 swimming pools, and if they filled all their swimming pools, they would be able to take X million barrels, and they could earn this amount through the spread. There you go. Everyone with the swimming pool, you think about filling it up with oil.
That's a no-brainer.
No-brainer. It's a market huddle no-brainer. Fill your swimming pool with oil.
I still think that on the short term, the fact that this was a little bit of a nothing burger. I don't want to say full-on nothing burger, but the patty was very small in this burger. There's a lot of risk.
It was a Trump small patty burnt to a crisp to eat with his small hands.
Well, let's move on. All right, things to watch next week. All right.
Okay.
So this is where I wanted to continue this conversation because Bank of Canada is going to come out, obviously, with this jobs number. I mean, we shut off the Canadian economy, right? And the jobs numbers reflecting that, and everybody's on the dole. And so you've got this situation. Bank of Canada is going to come out. We're already at zero interest rates, and they're already going to fund all of the government deficits to one degree or another. So, like, what do you think they're going to say? Like, is there you have any insights on how this is going to play out?
Well, I'll tell you one thing, Patrick. I think that the Fed is being aggressive and is fixing markets, and I think the Canadian Bank of Canada is being too timid. And there's a lot of markets that aren't quite fixed yet. We're seeing a lot of stress in the Canadian credit instruments. I was looking the other day at the break-even rates. So I know you're not very bullish on inflation rates, but what do you think the Canadian bond market is predicting for the next 10 years of inflation in Canada?
I don't know, 2%. I'm just
okay. So 2% is that their target, and obviously it's been trading below 2% lately because the fact is most people think they can't make their target. But going into the COVID crisis, it was trading at 140 basis points. Well, it dropped to 0. And it's rallied to 57 basis points. That's the Canadian 10-year inflation break-even. There is a lot of pain. A lot of markets are still not functioning in Canada. There was more stress in our credit markets than people realize.
And that's even with a weak Canadian dollar, which tends to be inflationary in itself.
Buying these Canadian break-evens is the biggest, opportunity in a long time. Now, let's compare that to the U.S. 10-year break-even. The U.S. 10-year, I'm just pulling it up on the old Bloomy here. The U.S. 10-year break-even is trading at 123.
Wow.
So
that's a huge discount.
Yeah. And there's all sorts of examples of things like that in Canada. Our credit markets are still trading with a lot of stress in it. I think Canada hasn't done enough. I feel like even on the fiscal side, we haven't done enough. I'm disappointed in our government. I'm disappointed in our Bank of Canada. I think we're going to find that we don't come out of this as well as the Americans do. I think I think they need to do more. I think they need to address the issues.
But do you think that that's going to reflect in equity, or is that going to reflect in the currency?
I think it's going to reflect in both. And I think that the currency is a valve that helps the equity, and that if they sell off the currency, it helps the equity compete. But on the whole, I just think that we're struggling, and they're not. I don't
see how the Canadian dollar in any way turns around unless there's a commodity boom on the other side.
Right? I have long been saying this, Patrick. Canadian dollar was going to be the world's weakest currency. I stand by that. The
Aussie actually did a worse than it for a little while, and the bounce on the Aussie recently has been pretty good. But come on, going back the last 3 months, Aussie dollar shit to bed in a monster. Well, it's because China was its neighbor there.
Because they were having China. The virus hit China first, right? Yeah.
Right, but the Canadian dollar wasn't the weakest. But anyway, so these commodity-based currencies that were in trouble in general, and it'll be really interesting. I think one of the great calls of the next 2-3 years is catch the turn, because once commodities take off, these currencies that are going to have been beaten down to a pulp, and there's going to be some huge asymmetry fading it the other way. Now, I'm not trying to even predict when that turn will be, but if you can figure it out, that's where big money is.
So back to the Bank of Canada policy announcement. I'm hopeful that they're going to step up like the Fed stepped up. Don't forget the Fed has, consistently done more than is expected. Canada has done less. And that's basically what I'm looking at, and I'm worried that we're going to continue to be mopes. All right. Get on the ice.
All right, so number 2, gold. Breakout or fake out. And listen, we let's not goocher it.
Listen. Let's talk about this because it's interesting. Let's talk.
This is, by the way, this is futures because the chart on the spot is a little different. So XAU USD.
So let's talk about that. The fact is,
notice here
the spot has not broken out.
Yeah.
There's a huge premium on the futures, and it's confusing a lot of people.
Sure, because there's supposed to be a shortage of physical.
Right. And it's the opposite, right?
Yeah. Instead, the futures are offering the premium, and the physical is.
So I have a theory.
All right, go for it.
It's no tinfoil hat. Basically, balance sheets are stretched. People don't want to go, and banks don't want to fund people to buy and hold gold and short futures against it. And therefore, when the people come for the gold futures, there's just not enough capital being allocated to buying gold and shorting the futures. Combine that with the fact that most of us are trading in our pajamas at home, and a lot of the arbitrages that we think we all take for granted are just not happening,
or don't have enough capital to do it.
Yeah, or a combination of things. We get these kind of dislocations.
Yeah,
and I would contend that just like we saw dislocations to the downside in the panic selling, we're going to see dislocations to the plus side in panic buying. And that's what we're seeing. Now, the real question is, what is the correct price of gold? I don't know, Patrick. I'm long,
well, I'm
tempted to say the futures are, but...
What we do know is this, is that even though during the liquidity, when the markets broke in March, gold got sold because in a liquidity event, the correlation of all assets outside of a currency go to 1, right? And so gold dumped. But gold recovered back to its highs, and whether you're talking spot or futures, they're at 52-week highs. And so they have been at least a preserver of some degree of your purchasing value or wealth or whatever. And you got an uptrend, which is attracting a lot of people that are looking for relative strength and momentum, and they're not finding it very few. They're finding it in very few places, and gold is a place that's one of those places, and it's getting its fair share of money flow, right?
Right. So, anyways, Patrick, the real question to me is, if you're long the June futures, do you sell it and buy the GLD?
Yeah, I think that they'll come back.
You think they'll come back? So you're willing to do that?
I think so. I think
I'm scared
a fool.
I'm scared of that because I'm worried that this will be the one time when it just basically takes off and doesn't. It doesn't.
Well, you're saying leave spot behind. You just think that the futures are just going to go.
I don't know, but my favorite saying. You know what the problem with a 4 sigma move is? Turns into an 8 or 12 before it's
there
done.
You go.
So that's what I worry
You heard
about.
it. The wisdom of the Muir.
Yeah.
All right, let's go. Number one. Does the stock market stall at the 50% retrace? Forget Fibonacci's. All it is that in the bear markets, there are bear market rallies. And often bear market rallies retrace or bounce half of the prior decline. And we literally hit the 50% mark, right? And so the 50% was basically right at 2,800. And so this 2,800 was, we went down from 3,400 down to 2,200, and half of that drop has now bounced back. And so now this is the typical level. Now this might, just because it's the average or the typical bear market rally doesn't mean it can't be more or less, but the point is this a bear market rally? Because if it's a bear market rally, this is a level where it should stall. Give or take 100 points.
So, Patrick, I actually wrote a piece on this, and I didn't reference you, but I was thinking about you as I wrote it because I remember after the 2018 Christmas massacre on the rally back up, we were both somewhat bullish at the bottom, I would say. I think we got that call right. And then we both got bearish at around, I can't remember the exact level, but there's a natural spot where it was supposed to stall, and we both got bearish there. And then I remember saying, hey, wait, it didn't come in, and I got bullish. And I took a lot of flack from everybody because everyone was like, no, this is a bear market.
Are you taking flack?
Well, no, I'm not even bullish right now because I'm too chicken to actually go out and say this thing's going to go straight up. But what I worry about, Patrick, in the back of my mind is that this is going to be a repeat of 2019. And don't ask me how. It doesn't make any sense. I completely agree with you. The only thing I could say is maybe the stack of blues on the New York Fed's order desk is going to overwhelm everything. But look at 2019. Do your chart, man.
I call bullshit on you. I'll tell you why. Okay. Because the whole psychological purpose of a bear market rally is to last long enough to convince everyone it could be real. It's supposed to make everyone psychologically feel that there was a major bottom, there's money being made, they sold to a thing, they got to get in, they're missing all this money. The whole psychological point of a rally. And so the fact that we're at the 50% retracement and you're contemplating that is actually a very good gauge as to the broader sentiment of a lot of people that are like, no, that was probably a bottom. That was the worst. It's all over. The Fed is taking care of everything. And that is exactly the psychological state that you would think that everyone should be in at the tail end of a bear market bounce. And so I'm a seller on your idea.
Okay. Well, if you can name anyone else that actually thinks that it might keep going, I challenge you to. I didn't even say that. Saying that.
No. You know what? There isn't a lot of people that are looking at it from that perspective, but the sheer amount of retail people that I know that are calling me about should I buy? There's so much, these stocks are so cheap. These things.
Well, no, but a lot of times that's because they all sold them and they're thinking about buying them back. There's an inherent short in a lot of those people.
Right, but in the end, they're being drawn in because they're seeing the price rising and they feel like they're missing out. That's the psychology of greed. Anyway, listen, I'm a seller on your idea. I'm glad that I think every one of our listeners is glad we're not agreeing on this, because if we were agreeing on this, there would be a real problem. And so let's see how this develops. Look. This is a very interesting level, and we didn't put this on the top 3 things to watch because we were going to agree on something. It's something for us to watch next week. We are at a very important level in the stock market, and it'll be really interesting over the next couple of weeks whether this becomes a turn point in the market or not. We're watching, right, Kev?
We're watching.
All right. So let's go on to the parting words of wisdom. What do you got?
So I'm going to use one of mine. Why don't you read it since it's mine?
No. I want you to sound like an idiot.
Okay. Do not focus on what should be done. Instead, focus on what will be done. And the reason that I bring that up is I try to repeat that all the time. And all these bears that are saying, but, and they're sitting there fighting the Fed. And I'm like, maybe it shouldn't be the case that the Feds should be, maybe they shouldn't be buying junk bonds. Maybe they shouldn't be doing QE of this size. But it doesn't matter what should be done.
They are.
What matters is what's being done.
Yeah.
And
Okay,
in that
all right.
case, I think it's just it's a kind of Jimmy Jude it's a Jimmy Judeism, in terms of really, honestly, he's like, trade the market in front of you, not the one you want, trade the market you have, not the market you want. It's another form of
Oh,
that.
yeah. That is a Judaism.
Yeah,
That's,
for sure.
Words of wisdom. All right, buddy. That's good. Anyway, so thanks everyone for joining us this week. We appreciate all the time you take to listen to the show. Well, listen, make sure you follow the show, subscribe to the YouTube channel, follow us on your favorite podcast player. We're on iTunes, Android Play, Podbean, Spotify, YouTube, all of it. Just make sure you share the Huddle love with anyone that you think would appreciate it. What else am I forgetting, Kev?
Share the Huddle love. Sounds like an STD. You're not forgetting anything. Just a big thanks to Jamie Wise, Ben Kwasnick, and Hayek and Keynes for great interviews. We really appreciate them taking time for us. That we had to do it remotely. It was terrific for them to make time. Make sure you check out their websites or their Twitter handles. And, have a great, safe week, and we'll see you next week.
All right. Thanks, everyone. I'm Patrick Ceresna.
And I'm Kevin Muir.
Thanks for joining us.
Lena.
Yes.
Hello.
Hello.
I wanted to talk to you about something. I actually wanted to talk to both of you guys about this.
Oh.
Do you guys know do you know who Dave Portnoy is?
Oh, sounds so familiar, but no, not really.
Yeah. So Lena, you know what? I was worried about this because you're usually my like anything that's from this decade. You'll know it. Patrick won't.
But I won't.
But he's the Barstool Sports guy. He's my guy that does one bite.
I know him. I know him.
Okay, Patrick actually knows him.
Oh, yeah, I know who you're talking about. Yeah.
Okay, so he's my one bite. Everyone knows the rules. Pizza guy. And for those who don't know him, he's this the Barstool Sports. He's this kind of. We actually spoke about this last week. I spoke with Steve Sosnick from IB after we did it on Twitter because he was talking about his pizza, and I said, "Oh, well, did Dave Portnoy come there?" And sure enough, Dave Portnoy came to his pizza place, and he admitted it was pretty good. So I'm gonna go to Steve's place because I actually trust Dave Portnoy's pizza reviews. Now, one thing I do not
When are
trust,
you gonna go?
Well, I don't know. Not like
once the quarantine is lifted, we'll go on a road
That's
show.
right.
Yeah.
But one thing I do not trust is Dave Portnoy's trading abilities because Dave has recently sold his firm for some stupid amount to this company PENN, PENN on the NASDAQ or New York Stock Exchange, and he's made himself like $50 million or $100 million. I'm not sure what the number is, but it's a big number. Okay, and he's decided since there's no sports to bet on, he's going to day trade. Not only that, he's going to do it all live for us. So he starts out and he makes a little bit of money. He makes 20 or 30 grand the first couple of days, and he thinks he's a genius. And then the rally comes, and he gets his fucking face ripped off shorting Boeing.
So he had beginner's luck.
Yeah, which is the worst thing you can do is to make some money right at the beginning.
Oh, yeah.
He's down $1.5 million. And he calls it a milli. He goes, I'm down $500,000 today. That's what he calls it. He's tossing around like 40 and 50 lots of Boeing at like an institutional trader for his own account. The guy is a complete and utter lunatic.
That's funny.
Listen, if you want something to do, you're bored, go follow him on Twitter. He live tweets it. You can see him blow up, and maybe he's gonna make it back. Maybe he's only down to 1.5 milli, and it's gonna be like next thing you know, he's gonna be up 2 milli. I don't know, but he's tossing it around. It's funny to watch. It's the best thing. It's the best thing. It's the best thing on the internet since those llamas escaped.
You know, we got to do that. We should just actually create like a live Huddle account and just like make fun of
Oh,
ourselves
that's gonna
blowing
be a
up.
mess.
Well, listen. Now you didn't
So
ask me
drunk.
about the llamas, though. I set that one up, and then you guys.
Oh, all right. What
Go
about
on.
the llamas? Tell us about the llamas.
Oh, gosh, can't set you up. You don't know how to take a cue or anything. So the llamas. I'm a big fan of like car chases, like sitting on a trading desk. I always like it when there's like a car chase. And you know what? The interesting thing about this is when I went to my new desk and I started teaching, like showing them the car chases. I go, look, here's a car chase, right? And like, you know, traders pass this kind of information along. My buddy Dave Lutz, he always gives me the car chases, and they're always in LA, which is awesome. And lately, by the way, they've been getting away because they go to the Sherman Oaks Mall, they take it in there, and then they ditch the car. It used to be they never got away. Like, they got all these cops and the helicopter, and then they would never get away. But now these guys have figured out they take it to the Sherman Oaks Mall, and they ditch the car. Anyways, I love the car chases. I know that's terrible. My wife thinks I'm an awful person for watching it. I don't care. I like it. Now, the best car chase or, like, episode ever filmed was in Arizona when 2 llamas escaped. And they followed these llamas around for an hour and watched the Keystone cops trying to catch them. And it was just a gong show. It's the best TV I've ever watched. An hour and a half of them trying to catch these llamas. They are slippery little creatures. You'd be surprised. Like, they're crazy. And then the best part is, at the end, basically this guy, from this redneck kind of guy, shows up with a pickup truck, and he's in the back, and he lassos them. He literally shows up, gets beside them, gets out the lasso, throws it around the llama's neck. It basically was a mother and a baby, although you didn't know that until later. Throws it around the big one's neck, pulls it in, and it's over. It was literally over in like 30 seconds once this guy with the lasso showed up.
Oh, I just watched it.
Yeah,
Well, I
Lena,
watched
can you put it?
kind of-
Can you? Let's put a link in the show notes for the people want to know.
Yeah, I'll put a link in the notes. But
It's
yeah,
the-
that's crazy.
Best TV ever. It was way better live. You can't watch it obviously an hour and a half now, but back then.
Oh,
I
so
was-
so like you're actually watching it live?
yeah, when I was on the trading desk, I watch all car chases and llama
instead of
chases.
work-
So
Working
like
and trading,
like
you
who
decide to
broadcasted
watch-
live? You have to go to like a local TV station.
Yeah, like
type
there's
of-
always links and stuff like that. Patrick, the next car chase, I'll send it to you. It's awesome.
What's
One
the
guy-
best part of watching car chases? Like, what is it?
I don't
Like,
know.
is
The
it
other
about-
day,
is
the
it about
guy
the chase, or is it
the
about
other day
what's gonna happen?
he went over all those you know, like when they put out the spikes. He went over the spikes, and then he had no rubber on his tires, so he's just going on rims. It was a shit
Oh
show,
my
man.
god!
It's awesome.
Do they think that they can actually get away? Like, is that?
I don't know. America's awesome that way, though. It's just awesome. And the fact that they publish, you know, that they actually go and show this on the news for an hour, it's entertaining as hell.
It's true.
Yeah.
It's true.
I'm telling you,
American news is very entertaining. That's for sure.
they're just crazy. Like this, the car chases are awesome. I know I don't want anyone to get hurt, so I like as long as nobody gets hurt. And I know that sometimes there's guns and stuff like that. Most of the time, I've never seen any of that though. Most of the time, they eventually just run out of gas, or that used to be
Or
that
they
the
drive
cops
into a
would
ditch or
go and
something.
try to like push out the tail end and make the guy spin out. So that's it. And sometimes another time I've seen them, the guys are like phoning someone, and then they're trying to like switch cars under bridges. It's like listen, there's a lot of strategy in this. This is like a lot of strategy. The Sherman Oaks Mall, though, that's the key. That's whenever that guy figured it out, and then the rest of the car chase
Wait,
guys
they
figured that
ditched
out.
the car and like ran into the mall. Like, is that what they?
Yeah,
did,
you just
or
take
what?
it off the highway and you go straight into the mall and you just whip it up in there and then you're done. It's almost like the police
What are
should be-
they running from in the first place? Like,
I don't know.
Is it a stolen car? Is it a drug possession? Is it
No
what is
idea.
it that they're-
It's just awesome. That's all I know. Okay, well, I've talked enough. What are you guys
Yeah.
watching this week?
I actually
Well,
don't
Patrick's watching The Wall. That's what's happening.
The Wall.
know. The wall.
Like, as in the wall in his house, because he doesn't watch TV.
Oh my god.
I bet he hasn't even watched all the shows we had mentioned in the previous episode.
I did start watching Succession. Like I got through like 4
Are you caught up
episodes.
now?
No, 4 episodes in.
Oh.
I
Patrick,
just
thought
we're
you were
stopped.
4
gonna do
episodes in, like 3 episodes ago for
Yeah.
us.
Yeah, no, I stopped. Yeah. I've got a busy
Okay.
life.
Okay,
No,
Lena, what are you watching?
I just finished watching How to Fix a Drug Scandal.
Oh, is it good? I've never heard of it.
It's a docuseries.
Yeah.
It's fascinating. It's about a lab tech that does drug testing to make sure, like, oh, the substance is cocaine, and this person's going to get indicted because of the possession or distribution or whatever. I don't want to give away too much for people who hasn't seen it, but there's a huge scandal around that, and the lab tech is on the hot seat for it.
I'm going to go
It's
look
about
at how
6
many
or
Rotten
7
Tomatoes it has. I trust the tomatoes. Do you trust the tomatoes?
I don't ever look at that stuff.
You don't look at the tomatoes?
Either do I,
don't.
but that's not a surprise for
the
the two of you.
Yeah, that is not. 86 tomatoes. That's a great score. I'm going to watch this.
It's good. It's like
Yeah.
you think that you're like, okay, like
Wait a
first
second. So
couple of episodes.
the more tomatoes, the worse it is, right?
No, the better it is. I don't know why that is. You'd think that the more tomatoes, the worse. Yeah, it sounds dumb. I don't really understand it. I just know that the tomatoes are like, I'll literally, if you tell me something and I think it sounds stupid as hell and it's got like 87 tomatoes, I'll watch it because I'm wrong.
I like crime.
The tomatoes are way
documentaries,
smarter
so.
than I am. Way smarter.
There you go.
They know
But
way
it's on
more than I
Netflix.
ever will. No.
It's on Netflix, and I thought it was fascinating because like when you watch it, the first couple of episodes, you're like, oh, okay, so that's what's gonna happen, and then things get twisted or whatever, and some other things that come up, and you're just like, what? Like, how does that happen? You know, it's like unbelievable story.
Well, I'm gonna watch that.
So.
That sounds like a good thing to do.
But it's my birthday this weekend,
Oh,
Happy birthday.
gentlemen.
What are you, like 24?
22.
Yeah, for like the 80th time. So, I mean, this
It's the
quarantine
10th
thing.
year anniversary of my 26th birthday.
Yeah, something like that. So
So what do you
I'm
got
just
planned?
Gonna, probably eat whatever's in the fridge.
Yeah.
And make myself
A sandwich with like
I
2-week-old
bought,
meat.
I bought a brownie mix and eggs so that I can make myself a cake
Nice.
of some sort, something sweet.
With 3-week-old
And-
eggs. They'll last.
Yeah, basically. So we'll see if I'm okay next week.
They'll last.
But yeah, we'll see what happens. Luke's just kind of scrambling, trying to figure out what he's going to do for my birthday since we can't go anywhere.
Well, everyone send Lena at the Market Huddle on Twitter some birthday well wishes if you've made it this far.
There you go.
There you go, Lena.
All right. Anyway, I'm out. I'm talking.
He's got to go catch up on the shows that we told him to catch up on.
All right. I'm going to go and do some. No, I'm not going to catch up on the shows. I'm going to watch a movie with the kids probably this weekend. So I'll let you know what movie I watch next week.
Sounds good, Patrick. We're looking forward.
All right.
Have a great week. Happy birthday, Lena. Have a
Happy
well-deserved, enjoyable birthday.
Thank you.
In between
I will.
editing all this stuff.
Yeah.
Patrick, you're such a terrible boss.
No go.
Couldn't give her
All
the
right.
weekend off or anything?
I don't know. You tell me.
All right.
Have a good weekend, folks.
Have a good weekend. Cheers.
All
All
right.
right.
Bye.
Bye-bye.